Well, howdy, everyone. We are back. This is Webby, and I have a very, very special guest for the Webby Rambles on Hangout series. In fact, he was the person who I thought of first when I was going to do these, and we just had to work out the schedule to have him on. And I couldn't be more excited to have someone I really look up to. Bob, why don't you introduce yourself to the folks who may or may not know you?
Sure. How far back do you want me to go, Mike?
Well, I mean, probably your great 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 grandparents, and we could start there and work forward. Just
Like,
yeah, just let them know who you are.
all right. I used to tease my kids that I remember 9 months before I was born. Oops.
Yeah, oh, take your time. Don't worry about it.
Can you hear me?
Yep, I can hear you.
Yeah, I remember going to 9 months before I was born. I remember going to a picnic with my father and going home with my mother.
Are you kidding?
No, I'm teasing.
Oh, okay. For a second there, I was like, "What is that even possible?" I'm like, if it could happen with anyone, it would be Bob.
Yeah,
I'm
that'd be it. Yeah.
like, wow, how is maybe there's some way.
I always tease my kids with because we're always testing our memories and how far.
Oh man, my memory, I don't know if it's gonna just get a lot worse, but it like I
Yeah.
don't know about you, but I can remember stock stuff without a problem, but it's the rest of life that just is kind of a blur.
Yeah, I've been in. I don't know if it's fortunate or not. I can remember pretty far back, at least maybe kindergarten stuff like that. Certain events.
Really?
Yep.
Wow. So what is your first thing that you can remember?
Well, the first thing I remember is I don't know, remember exactly what I did, but I had to stay after school and write on. In those days, they had chalkboards, and
Oh
that
yeah, yeah.
Bobby will be a good boy. Bobby will not talk in class.
So you were a Bobby growing up?
First grade buddies at that time, they're all outside in the window, making faces and all the things that little boys do to each other. So,
Oh, that is so cool. Well, the one thing, I know that you met your wife very early on. Now, was that in elementary school or junior high or?
our parents went. Well, she moved into the town that we grew up in. She was 4, I was 8, and our parents became best
Oh,
friends. And
wow.
so I've known her since then. But I didn't ask her out till I was 29, something like that. Yeah.
29. So you knew each other that whole time. Were you close?
Well, she was close with my sister.
Okay.
Sister's 4 years younger than I am, and that's how Barb's 4 years younger. In fact, she's going to be 70 tomorrow. So,
Oh, wow. Tell her I said very happy birthday.
yep,
That's
yeah.
wonderful. And I'm so glad that she's letting you do this because I know you got the family there and the grandkids and everything, and you're taking time out. If they want to come in and bother grandpa, I'm totally down with that. I can't wait to be a grandpa.
We won't have any choice. When they come up here, they'll be here.
Okay. That's wonderful. And tell everyone, so you're in Michigan right now and you split your time between there and Chicago, right?
Yeah, most of the time we're here, Michael.
Okay. So, all right, everyone, we had some technical issues. It happens. We are back now, and we were just talking about Bob's, history, and maybe what we'll do is start with your first thoughts of trading, and whether that was super young or later in life, and how you got interested in the market.
Yep. I had an interest in it relatively early, Mike. I had a uncle that bought a little company, not a little company, but he bought a public company called Brock's Candy.
Okay.
This had to be, let's see, probably early 60s. I was old enough to know that he made a lot of money on it. So
Uh-huh.
that just got me interested in it. But I really didn't get interested in it until I was 19.
Okay.
When I went to college obviously at 18, which would have been 1969. I originally went to play football, and
Oh, I didn't know that.
yeah, no, I was a decent athlete. But after 1 year of football, I realized that probably wasn't my calling, and
What position did you play?
I was a running back.
Oh,
And
wow. That's
Mhm.
cool. You
Yep,
must have been fast.
I was fast. I was
Oh,
fast,
cool.
pretty strong, back in those days.
Oh, good for you.
Yeah, so I did that, and at the school I was at Illinois, I tried to switch to golf because that was my other love because I lost interest in football. and they wouldn't transfer to scholarship. So I gave that up and transferred to DePaul University in Chicago,
Okay.
and because I just came from modest. My parents were just average kind of middle class people back in those days. Uh,
Yeah, I mean, my father was in the Marines and my mother a teacher, so I know what you're talking about.
yeah. So I had to find a way to pay for college. And so I went to the placement office in the business school, and I just picked the one that had the highest hourly rate.
Hmm.
Um, and that's what got me into the business I'm in. The president of the firm was looking for a part-time assistant. And so I was 19 when I really started. So like 1970, yeah, 1970.
Oh, okay.
It was an investment banking firm. It was the largest commercial paper dealer. It was a firm called A.G. Becker. And he put me really on two assignments because I all my classes were in the morning, so I could get out of school at 11:30 and then be right at work. And so he gave me two assignments. They were moving their profit sharing plan internally to be
Hmm.
managed internally. And the fellow that they gave the management to is Richie Driehaus. You know who he is?
Yeah,
Yes,
yeah.
yes. He's since passed away. So that was my first real exposure to stocks at that level. And he was a growth investor. So I was doing research and analytical work for him. And then my other assignment is a couple investment bankers had clients like investment banking clients, and
Hmm.
they had these assets called pension funds, and they didn't know any way how to measure it and how to compare performance. Remember, this
Yeah,
is the early 70s. Back
yeah.
then, most of the, I shouldn't say most, but I'd probably say two-thirds of all the assets were managed by bank trust departments.
Okay.
There was few firms, but most of the big money was managed by bank trust departments, and they were all comparing themselves really to the Dow Jones average. And so we created a database. We went around and got returned. Can you still hear me?
Yep, yep.
Okay, good. Um, and anyways, we created a performance measurement service where we could rank all the managers around the country. So it was my job to just call up people, even like Peter Lynch, and
Oh, wow.
convince him to give us the data on his performance. And so I went around all the firms to gather all the data.
Oh, man,
And
you must
so,
have had
yeah,
some
so
interesting
we built.
conversations.
We built. Hopefully, I didn't lose you.
No, no, I can still hear you.
Okay. So we built a database. I can't remember exactly, maybe 400 or 500 managers, which included bank and trust departments at that time, and we
Okay.
had a data measurement or performance measurement service, and so
So
we
did you ever look into like when you saw the guys and gals that were doing really well there, did you ever talk to them and say, what are you doing? Or was it more you're just collecting the data and then putting out
well,
this?
we collected the data, Mike. We collected all the data, so it was all their buys, the sell,
Oh,
the dividend. So we had
oh, you had access to everything then.
I had access to what every top professional manager at that time was doing, and the
Oh,
one I
wow.
gravitated to was obviously Peter Lynch is the most well known, but the guy named Jim Stowers from what's then called American Century, now 20th
Yeah,
Century Funds. Okay, they
yeah.
were just getting started. Oh, there was a handful of managers that were their numbers were just so much better than the average, particularly the average bank and trust department. So that's what really got me involved in growth because I could just see that it was if you could catch certain stocks that would be the outperformance of those.
Did you make any like mental notes of the ones that were doing really well, like what anything unique that they were doing? Like, because if you remember, like when Bill figured everything out, he did this study on the Dreyfus Fund, and he
Mm.
went in there and he saw he got. I actually have them, well they're upstairs now, but I have some of the original stuff where he looked and he figured out, oh well, he's buying all of these at brand new highs, and that really was the thing that kind of changed his career. Did you were you able to have the time, or you were just so young that you were just doing your work and
Yeah, at that time I didn't do that. I could just see what they were buying. I didn't have any at that time. We didn't have any charts for me to look at.
okay.
because I wasn't in at that when I was doing that project. I wasn't actually managing money, but
Okay.
other than helping Richie manage the assets for the firm that we were at, and he was growth, and he was. I would probably say he was a little bit more of a momentum investor, uh,
Okay.
and so that's what caught my attention.
Oh, well, interesting. So when did you, now I know in what I've always been fascinated by you is when you started, because you started in the 73, really got into it during the
Yeah,
73,
that's when I
74 bear market.
started full time January 2nd of 1973.
Wow.
Yeah,
So
my first
folks who
2 years
don't know
were brutal.
the,
Well, that in hindsight, Mike, that was probably the best lesson I've ever had. I
yep.
mean, it didn't feel like it when you were going through it, because it was.
I, I agree because when I got money to
You studied
run,
that period.
well, when I got started with running money for Bill, it was. Are you able to hear me at all, Bob?
I just got a little buzz in my ear. Uh,
Okay, so
yeah,
when I started running money for Bill, it was right at the beginning of, well, it was the tail end of '99, and my first trade was January 13th of 2000. So I had like 2 months of a good market. Then
yeah,
I had that 2000 to 2002 terrible bear market. So whenever I think back at that, and as a kid, doing that and starting off a career that way, even though my career had really started in 1993, that's when it really,
right.
I'd hit an inflection point and became a PM.
Yep.
That I always equated that to you and you starting off in that 73, 74 bear market. And
Mhm.
Bill would always come into the office. That was back when I was sharing the office with him. And he'd say, Mike, this is the best thing that ever happened to you. You're going to learn all the things not to do. And I
Yeah.
just looked at him. I'm like, I don't want to hear that. I just want to make some money. And you could probably relate. Like you learned probably so much in 73, 74, and that's probably why you were able to do what you did over your lifetime, is because you learned, well, that stove is hot, and don't touch it. I mean, what are some of the key things that you learned from the 73, 74 time frame?
Well, obviously, the first one is when you can. Now, everything I've done has been on the institutional side,
Um,
which is. Do you want to take a couple minutes to talk about the institutional side, or do you think most of your?
I want to take a couple minutes to talk about everything. You can go in as much detail as you want. Like
All right,
please.
okay.
I've been telling my better half, like for the last month. I'm like, I cannot wait to talk to Bob and hear. Like, I'm really like,
Well,
dude,
thank
you have
you.
no idea how excited I am. So
Yeah.
tell me everything. I want to
Well,
hear.
I think it might be important for the viewers just the backdrop. And then we can get into 73, 70.
Sure.
So I've never until I kind of semi-retired, never managed any individual money other than my own. Everything,
Okay.
pension funds, back then they were profit sharing funds, foundations, endowment. So they're all tax exempt. So I didn't have to worry about tax consequences or any of that. But in that market, they would give you 3 to 5 years to perform.
Okay.
So one thing I learned is I never had to be in a hurry. So I didn't have to get full positions right away. I didn't have to scale up as much. And then the other thing is they would not allow you to put more than 5% in any one security.
Oh, that helps so much. That helps. Like that right there is gold, because that solves so many problems.
So you minimally had to have 20 names. So I'm used to working with a lot of names, and
Yeah.
I still pretty much do that today. When I enter something, I usually just enter with a 1% position, and I don't. One of the lessons that came out of 73, 74 is when you buy something and it's not working, don't add to it.
Yep.
So I never add to I shouldn't say never, but rarely will I ever add to a losing position. And then I'll start with one, and then if it keeps moving, I just feed it every day. And in those days, we could feed it as fast as we wanted to, up to 5%.
Okay.
And then my partners and I, we had to go around and talk to all the clients to convince. You could still hear me?
Yep. Yep.
Yeah, yeah. To convince them that when we got to 5%, we didn't have to scale back, because in the beginning you'd had to scale back. So if
Oh.
which when you think about it in hindsight, or coming from your level as a trader, why would you want to cut off your winners?
Yeah, I know.
I mean, particularly I got a 5% position and it's starting to run, and you want me to cut it back. I mean,
It makes no sense. It
that
makes
was,
no sense
that
in
was
our world.
yeah, that was the rules if you wanted to play in that game.
Okay.
Um, and we made a decision back then that was the game we wanted to play because we were pretty active when well in '85 when with the other partners I joined, Mike. It took us a couple years to get traction in the marketplace. Um, just because we had high turnover. Back in those days, they thought high turnover was churning, and all you were doing
Yep.
was helping out the brokers and
Yep.
the clients. But anyways, I'll maybe get to that later. So you got 3 to 5 years. You had to have a maximum position of 5. We convinced them to let us at least let it run up to 8 to 10% range, and we scaled back. So that helped me with the scaling process.
Mm-hmm.
Because as you know, you can let something can run and run, and then when it decides not to run, it can roll over pretty quick and pretty fast.
Big
So
time. Yeah.
it also taught me that you just can't hang on forever. Also, okay. And then the other lesson I got is I never understood. No, I'm only young, 22, 24 at that time. How low stocks can get because I remember, God, I think Pepsi was maybe at 140, 150, somewhere in that range, down to 60. And um, I mean, just stocks were cut 70, 80% from their rich. That was a key lesson that you just don't want to hang on forever.
Well,
Um,
I think
yeah,
you starting. Are you able to hear me,
yeah, I
Bob?
can hear you. Yeah,
Okay, cool.
you
So
gotta come out every once in a while.
yeah, that's going to happen. So I think you starting during that time frame, and it was that slow bleed, like the 73, 74. What most folks don't realize, I mean, you obviously realize it, but that was the worst bear market at that time besides the 1929 crash, 29 to 32. I mean, that was really, really bad, and anyone to be able to live through that and still stay in the business, I think is huge, especially starting off. And I brought this out. I went to my books and or my boxes, and I got this thing out when I knew I was going to be having you on. This book that I did during the this was during the 2007 2009 time frame, and I started getting obsessed with the 73 74 bear market, and I went through, and all of these are just it's just filled with charts of all the stocks during that time frame, and I went to our archives and got out the the stuff with the earnings line and went and photocopied them just to see. The point to me was that the earnings could keep going and going and going in these great stocks, like what you're saying with Pepsi and stuff falling so much, that these perfect companies with great growth profiles, return on equity, everything was there that both of us like to look at, and obviously Bill did,
Mm-hmm.
and they just kept going down. But it was because the market was just so bad, and it's just such a reminder to myself that of what happened in 07 09 happened in 73 74 happened, it happened. And such a reason to not just fall in love with some companies and go, oh, that's so good, just hold on forever. So if you could just expand on that, because I think there are a lot of people out in the audience who have some pet stocks that they just love, and they just think that they're great. Maybe they love the CEO or the product or whatever, but tell them what you've seen over the years, because there are a lot of new people out there that just don't really grasp that.
Yep. Yeah, after that period, it certainly taught me that you should not hold on forever, and you need to help whatever percentage that you wanted to use. When we started a position, even back and then, if it went down about 8%, we would cut it. And we would,
Wow.
like I said, we started with 1%, but we would not add anything. So the guys I was working with that were teaching me, I wasn't the creator of this. Remember, I'm only 22 and 24 years old through that marketplace. Um, we used to call it Chinese water torture. I mean, every you got to come in, and it
Yep.
was because and the markets moved slower back then, at least in
Uh-huh.
hindsight, it feels that way.
No,
Uh,
they, I mean, from studying it objectively, they really did move slower back then.
office that said, "Well, wow, this is going to really be a bad day." It was just a little bit here, a little bit there. Um, and the other thing I learned out of it is when it wants to turn and move up, it just happens. Because I remember October 1974. Right around there, October and November of 1974. I had no idea if I was going to still have a job. My bosses called me in and he said, "Well, what are you worried about?" And I said, "Well, God, we're down 32%." He said, "Well, in our business, the market's down 54. We don't have anything to worry about. Our clients
Yeah.
love us."
Yeah, it's a relative game, you know?
2% people like us?
It is such a different mindset for anyone in retail to understand that part of the institutional. It's all relative, and you could be up 20%, but if the S&P is up 30%, you did a terrible job, you know. So it does cut
Yeah,
both ways.
it's a relative performance game, and they really do give you time. And when you think about it, we were never the sole manager for any of these clients because they might, like the state of California, maybe in my days had 35 or 40 billion dollars. So they would hire us and maybe give us 50 million. So they just said, all we want is you want you to do your growth, momentum, earnings surprise, and just find the best stocks for us and whatever your performance is. So they took care of their own asset allocation and diversifying by hiring aggressive growth or maybe growth or yield and fixed income and all the other stuff that they do.
So
Um,
kind of like what
like,
some people might think of as like it was in a way a fund of funds, even though it wasn't. It was like pension money and retirement money, but they were saying, okay, we're going to give this sliver over to Bob and his guy and his team, and they
right,
do momentum growth, and then we're going to put this other sliver over with these deep value people and these other, you know, like they're
right.
going to just break it up that way, and that's how they're managing their risk, which is great because then it allows you guys to do what you do best, you know,
Yeah.
and you don't have to try to be
Well, they would still put the same restrictions on us. You wanted you to be fully invested, and
okay.
they basically a maximum of 5%. So we were the only way you can protect yourself. Well, we were able to convince clients to let us go to 25% cash in a bear market. So we did have a little bit of
That's
buffer.
a big deal.
Yeah, but that took a lot of effort and work, and not all the clients went along with it. They just said, "Listen, you got 3 to 5 years to do your thing. We're going to compare you to other growth managers. If you're above average, you don't have anything to worry about." So you had time on your side for your stuff to work or your strategy to work.
Well, I think that's great that they used to allow that amount of time because as you know, you're as a manager, you can be just hot and cold, you know, in a given year, and it also even you personally just picking the wrong things or doing the wrong things, that happens, but also your style might just not be the right style for that particular environment.
Yep.
And so I think that that longer time frame, the 3 to 5 years, is great because it kind of it works that out, and it keeps that pressure away from every quarter. You've
Right.
got to connect the ball, you know. And well, that's wonderful.
That's the nature of those funds for foundations, endowments, pension fund money. They're long term nature assets to begin with because
Mhm.
they don't they're assuming they're close to fully funded. They're trying to play out for the next 5, 10, 20, 30 years for those assets. So, but
So with that, so you were there at the firm, you know, and you're 22 and you're starting off, and you end up in this terrible bear market. Then when the bear market finally turns, were you still at that same firm? And then,
yeah,
and if
yeah.
okay,
I stayed there until late '84 when I joined the two other partners who I would put them equivalent to like I was the one like working like you were working for Bill O'Neill.
yep,
I was working for those two. They
gotcha.
they were what I would have called the father of momentum and earning surprise um, investors. They were real early in the game.
And
Um,
what were their names again for
uh,
everyone?
uh, Erwin Smith and Don Shabukas.
Okay, yeah, I just wanted everyone to
No, Don
know.
was the one who maybe both of them did, but Don, I remember he had a pretty close relationship with Bill. your
Oh,
bill.
okay.
In fact, in Bill's first book, he mentions Don by name in there
Oh, okay.
as one of the institutional managers who was using kind of his methodology of picking stocks.
And you guys were clients of William O'Neill and Company for quite some time, right?
Yeah, I mean, I think we started using them late, maybe late 70s.
Okay. And so you were you getting the Maroon books or were you getting some other books?
No, we were getting the books, and then we used Wanda when that came available.
Yeah, I love Wanda. Nothing's been better before ever, man. And anyways, that's a topic for another day. So
Because
the
that earnings line was what I would always key on. That was
earnings line done the way we did it in Wanda, and then with the estimates going forward, when we added that, it's especially on a monthly chart, and that's something we're going to add to Market Surge because I
good.
really want the earnings line on the monthly as well as having the estimates out there. That's a whole topic, but um, why don't you talk about your earnings surprise thing? Because I'm totally, that's such a huge thing, and you guys were way ahead of the game there. Um, Talk about that and the importance because it was important back then. It's still important now.
Yeah, I think so.
Um, you know, why don't
Um,
you explain that to everyone?
sure. The first thing we wanted momentum, so we would plot the stuff. So
Okay.
on the up and down axis, we wanted momentum, which would be year over year earnings growth, and then on the horizontal axis, we wanted what we called earnings surprise.
Okay.
And we probably calculated a little. I'm not sure how IBD calculates it, but we were kind of well. We basically we were taking the quarterly what we would call error. Well, let's put it this way: a company is supposed to earn $1 for a year,
Mm-hmm.
and they earn 25 cents for the quarter. We'd take that, and so the surprise was zero.
Okay. Gotcha.
You get that, and then let's say they earn 50 cents for a quarter, and we divide that into the dollar for the annual estimate, and that would be a 2% surprise. So it'd be up on the scale.
Gotcha.
We want earnings momentum, earnings surprise. And then what we would do, Mike, is we had a grid. I think I posted it once before.
Yeah. No, you posted a couple times, I think.
Okay. So you could see companies wrote they could have high momentum but negative surprise
Yeah.
because you see that sometimes today. A company could grow 40%, but everybody's expecting it to grow 50. Well, that would be a negative surprise to
Yeah.
us, and so you probably either want to scale back or eventually get rid of it. And but you could see companies go from high momentum, negative surprise, and then you got low momentum, negative surprise. And then when you go through the cycles, you could see companies begin to move over where they had earning surprises, but still low growth. And then they would move up to the right hand. So we would kind of do that for, probably, well, we certainly did it for the S&P 500 stocks, all of them. And then we
Okay.
on our portfolio.
So let me ask you, what was your measurement or measurements for momentum on that? Because it was momentum in the earnings and the earnings surprise. What was were you
It
using
was,
RS or what?
no, it was just earnings growth, year over year earnings growth.
Oh, okay. Year over year earnings growth in there
And
was
we
so it
did,
was all momentum of the earnings, not momentum of the stock in on this.
yeah, for each individual stock.
For each individual, and you would do at least the S&P 500, all components, and maybe some extra ones that you guys were
Yeah.
looking at.
Back then, we didn't do anything with relative strength back then.
Okay. So where now, let's say you've got a company and it clicks, it's in the right box where you want, where it's got the earnings momentum as well as it's got the earnings surprise on there. Now it's with folks these days, when an earnings comes out, you've got this big gap up because it's post Reg FD. But back in those days,
We
you
did.
rarely got those gaps moves. So
Yep.
what would be your entry point? Would it be as soon as the earnings came out and you mapped it on there, or what? How would you get into starting with your one
In
percenter?
some cases, when the earnings came out and it was a surprise and you could see it begin to move, would be an entry point for us, Mike. But the other thing that we developed after several years is we tried to get in front of the earnings because we found out you could take each individual company and
Mm-hmm.
identify 4 or 5 key, what we used to call key factors that would affect the earnings. And then you
Okay.
you could talk to company managements, which we did. You could talk to Wall Street as a generic term, wherever analysts were located, and you could build a consensus estimate around each of the key factors that should affect earnings. So you could monitor those month to month. And so it shouldn't, what we were trying to do is get ahead of the surprise by, if the key factors
Yeah.
were doing well. So, if Apple was supposed to produce X number of iMacs back then, and you
Hmm.
could see that they were producing more, well, intuitively you could say, well, that's going to have a positive impact on the earnings. So we were trying to find a way to get in before the earnings, and we were and back in those times, we were very successful at doing it. And then the earnings turned out to be the confirmation that we were on the right track. And if the earnings didn't come through, it told us we were on the wrong track and we would exit if we had a position.
Well, that's great that you guys were doing that, and it must have been a ton of legwork because if you're doing, looking at your universe, which is 500 plus stocks, and then each stock. Now, obviously, you couldn't do it in detail for each stock, but the key ones, and if you got like five metrics, and you've got there's no internet back then. Like you're having to call around. Like,
You're
what
calling.
were you doing? Just phone calling everyone, right?
Yep. And,
Wow.
and we had a staff, Mike, of, well, in the early days, maybe 10 people. They're
Okay.
and that was their job. And then Wall Street would feed you information because back in those days, you would do the brokerage business through them to pay for their time and their effort and their services.
Like the soft dollar type of thing.
That's exactly.
So with that, I mean, just so folks understand, what type of size you were running. I mean, you guys at your peak, what were like the assets under management were, substantial.
Yeah, I think inner quarter or 12 billion was at our peak. Um,
It's like, I mean, and that's back. I mean, 12 billion now is a lot. 12 billion back then is like even more. I mean, that's huge. What
but
did
can
you
I,
ever feel the pressure with that size?
yeah, can I first let me when we started the firm, we started with a couple 100 million, and then we were able
Okay.
to build it up. And then in 1992, PIMCO wanted to get in the equity business,
Okay.
so we sold ourselves to PIMCO, and
Oh, okay.
they were the ones because they were getting into mutual fund business and that stuff. So I'd probably say maybe 6 billion of that came from our relationship with PIMCO.
Oh, okay.
Okay.
Well, Pimco and I, at least back when I was in college in the '90s, they were located in Fashion Island in
Each has
Newport Beach.
there.
Okay. And that was the first job I ever interviewed for. And I was an econ major and I was still in school. And I went in to try to get a job there. And this nice lady, she wanted to give me the job so badly because I'm a nice guy and everything. And she saw that. But I just was not qualified. And she kept on leaving and talking to people and coming back in. And she had to tell me, I'm sorry, I don't have anything for you. But so every time I drive by
Oh, yeah.
that building, that really cool building there, I think of that. And she was a sweetheart, but
Hmm.
I wasn't the right person for the job, man.
Yeah.
You know,
Yeah.
they were a big company. So
So we,
going back to that time, because I don't want to skip ahead too far, like
I,
to, walk me through like any of the things that are key during that time that I'll find interesting, because if I find it interesting, I don't care if anyone else does. I want to know. Like, tell me about that time. Like let's go maybe to like the 1987 year because I know that well, I kind of know part of that story. Why don't you tell everyone that because it's a fascinating year in the market.
yeah, 87. So, when I joined the two partners I mentioned before, so we were basically at it just a little over 2 years.
Okay.
And, and we might have gone from, say, 200 million to about 300. So it was a struggle to gain assets. And then in the, I'll call it the tax exempt world, the way they do that, they're looking for a growth manager. They usually would hire a consultant. They would bring in what they considered the three or four top growth managers for what we did. And then you go through the interviewing process where you had to explain what you did, how you managed money, who your clients were, that stuff. And we were getting rejected all the time because of our turnover was too high.
And what was your turnover rate at the
It
time?
was about 130%. When the
That's
institutions,
nothing.
oh, to us, it's nothing today, but
Yeah.
Mike, it was, they thought you were just churning the account. I mean, we lost more new business presentations just because of that one exhibit that was in the presentation.
Wow. Wow. My turnover number was one thing that Bill would always give me a hard time about. But all of our numbers were high, but mine was just higher than everyone's. And if I told you what our numbers were, you just wouldn't believe me because, we go and we cut and run. And I
Right.
mean, he had to like double check. It was like, is this a real number? Like, because you think about it, if you go in with size and then you cut and then you go back in, it like those turnover numbers are, I
Yeah.
understand 130 is a lot in that world, but what would you say? Well, explain to people what a turnover is because some people might not know what turnover is.
Well, turnover basically is that, if you start with this, say five stocks and you sell all of them and then you buy five more new ones, you got 100% turnover like that.
Yeah.
And we were always good at cutting losses. Like I said, we'd start with a 1% position. If it didn't work out by eight, we wouldn't add. And most of the time, we would eliminate it. And even back then, I mean, you see what the turnover is today. I mean,
Yeah.
things don't all work out, or might not be the right time, and so you'd have to revisit it later in the future. But in that world, it was a no no. And but what turned us around was in '87 we got through the year up about 12%, where almost everybody was negative, and all of
Oh
a sudden
my God.
people didn't care about turnover anymore. So
Yeah.
in fact, one of the issues we had in late '87, '88, '89 is the assets were coming in so fast that we were afraid it was going to affect our style.
I
Because
bet you. Well, did it?
yeah, it did a little bit. The way we dealt with it is we created two new products. Before we were
Okay.
kind of, I guess you would call it a large cap growth manager then. So
Okay.
we decided to segregate the market. So we created a small cap um, environment, same process, same approach, and then we did a mid cap maybe a year after that. So to us back then, small cap was I'd say 2 billion and less. Mid cap was in that 2 to 8 billion,
Okay.
and anything else was large. So you could have an Apple be a small cap um, company, and then
Mm-hmm.
it would move into our mid cap, and then it would move into our large. So sometimes we would just keep it in all those because they didn't
Oh, okay.
move it out. So it helped create all that.
So
But
I'm curious. I have so many questions on that, but the first thing is so with that Apple example, and it starts off in the small cap, then it goes to mid, and then it's big enough to go in the large, and you still
Mhm.
kept it in the small. What ultimately were you guys looking at? Was it more fundamental or technically based? Like the 8% is a given. Once it's down 8%, you're going to. So I'm going to just summarize it as I understand. You
Mhm.
guys have a max of 5% position that you can put it into. You can allow it to grow up to maybe 8 to 10 before you start trimming back. You
Correct.
start off with 1%, and if it's working, you guys are building it up from one to a max of five.
Correct.
So I got a million questions about each one of those. So let's start off at the very beginning. So you start off with your 1%. If it goes down 8%, you're out.
Right.
But if it doesn't go down 8%, what were you looking for to start saying this might be a 5%er? And how much time would, on average, would it be before you get it from one to five?
I'm only going to have to guess, Mike, because I didn't keep that number. But
Sure.
and some of it obviously was how fast the markets were moving. If they were moving pretty fast, I mean, we could do it in. Uh, it would probably take us 2 to 3 weeks just because of the amount, particularly when we got
Yeah.
size. I mean, in the early days, it didn't matter because we weren't affecting markets. But one of the things that we used to keep track of is we did not want to own more than 3 to 5 days of the daily trading volume because otherwise
Hmm.
it takes for a long period of time. So that was kind of one of our guiding posts in terms of how fast we would move in. But we could do it in a couple weeks to a month. We would get there.
So I think that's what people really need to understand is that's how the institutions really work. And so when you're seeing the things like Bill would say 5 weeks up in a row on the right side of a base or something, it's guys like you who are in there and saying, okay, it's a 1% position. We wanted to get it up to 5%, and it only trades X amount of shares a day. If you become all of that volume, then you're pushing it up. So you've got to do it at a pace, and that's what accumulation looks like. Like it's your footprints that we're seeing with the chart.
Yep, exactly.
Yeah,
Exactly. And then, and you consider how big some of these firms are, it takes forever to get in and out. So,
yeah.
and so when we took a position, we had our own trader who would kind of shop the orders around back in those days to different brokerage firms. But we would give them price. Don't buy any more over 35 and don't buy any less than 32. So we would give him a range and he would just kind of work his way into that position. Um,
Well, that's fascinating that you would give them that top on there, and that's what we would do with when I traded O'Neill until the end. We would call the desk, and you would have to give them your order, and some people
right.
would just be like, "Buy 10,000 XYZ." You figure it out, or some of us were very picky, like myself, and be precise like that. Like you have a top on there. You can run it up to this price, and what's interesting is you can see that on a chart,
Yep.
where it's just keeps on running into the ceiling, and it's people like you, like our size was nothing like what you were running, and it goes up to that thing, and it just won't go beyond that because you're not buying,
No,
and
we won't buy there. Maybe with time we would, because that it wasn't a static. I mean, as you go through time, obviously prices are going to move because earnings are going to move the stock and that stuff. But when we're trying to enter a position, we would always put an upper limit on it. We would say we just don't want to buy anymore at that point.
well, that makes sense. So, what would in a perfect world you're buying it at 1%? It's moving up. You take that time to build it up to a 5%. Luckily, it was in a pre-Reg FD, so you didn't have to deal with as many gap downs.
Right.
But let's say you had built it up, you just built it up to a 5%, and then some weird news came out, and the stock gaps down. Back in the day, maybe 8 to 10% gap down would be really big. How are you, but you're still up on the position. How would you guys look at it? Would you sit there and say, we've got so much size that if we start selling, we're going to crater this stock? Or what were you doing in a
Yeah, if
position like
it
that?
was a real negative story, Mike, we would do our best to get out, or we would call Goldman Sachs and say, "We got 125,000 shares. What can you do, and what can you get us out?" And then they would shop the order for us. Uh,
Okay, and then you just might get
Back in those
filled like
days, you had
below the
dollars.
market that you're out.
Yeah. You just,
Okay, so you wouldn't
but
sit like,
it still may take a week or 2 weeks for them to get us out of something. That's
okay.
something that we wanted to get out of wholesale. When we had the winners, we may be scaling back once in a while, but most of the time we tried to hold on as long as you could.
So let's say you didn't have a gap down. You've been in this, and you'd bought Apple, and it was a small cap, and then it was a mid cap. Now it's a large cap. So you've got it in all of them. You've got this positive relationship with it because it's been giving you this positive feedback.
Mhm.
Now every every stock tops.
Yep.
So when it did top, what were the signs that you were looking for to recognize that? And would you guys sell evenly throughout all of the funds, or just say, okay, we're gonna keep the small cap one because we can't buy that back because now it's a big cap, but we'll sell the big cap? Or how did you approach it?
Yeah, when we turned negative on one, it would eventually leave all of them,
Okay.
small. Yeah, because it didn't make sense to us that to keep it in one if the company was deteriorating, or like if Apple wasn't selling as many iMacs. Remember, we were also trying to get in front of the earnings so that we could, when we could see that they weren't selling as many of the product or whatever the company was, we didn't have to wait for the earnings to be announced to sell it. Or
Okay, so then you would be getting out, and would you take on average? Would it be longer to get out, or now you've flipped the switch? You've made some calls, and the IMAX are just not selling, or there's supply chain issues, and you know that it's going to be a drag on the earnings, and so you want to exit it, and you've got size in it. So what is the procedure for? Are you telling desk get us out by the end of the week, the month, 2 months? What
Yeah,
is your thought process?
yeah. We tried to do things for the most part in thirds, so we would try
Okay.
to third out as fast as we could,
Okay.
and then because you know how markets move. I mean,
Yeah.
they could go down, but you'll get these drifts up, which creates selling opportunities, and you know you've seen it, and um, the people you work with. You could see it in today's market too, that you
Yeah.
know, a little crater, and then you know that's why I rarely ever sell anything on a bad day. I always wait for that's somewhat of a bounce to get back if I want to trim it or cut it or all that stuff. And that was
Well,
just
no, no. Walk through that because that's fascinating because it's different than how I'm wired. Because Bill was more like once it does this, you just
blow it
you're
out.
out.
Yeah.
So, but I see the benefit in what the way you're doing is because it's like when it's cratering, people are just like piling on you. Then you've got shorts and it's just going down, but there's this natural lift that it would bounce like a quarter of that move or maybe even a 50% retracement of that. So walk through that. So it goes from $100 down to $80.
Hmm.
Now, at what point are you waiting? Are you waiting for it to get to 85 to 90? How are you scaling out of it in a situation like that?
Yeah. Well, first of all, just to clarify, that's assuming I have a cushion or we had a cushion in the stock.
Okay.
If something we just started and you get one of those craters, we usually would just blow it right out. Okay.
Okay. Because
Well,
it's
and then we
too close to your 8% loss.
some bad news came out and it goes, you know, in your example from 100 to 80, we would usually give it a day or two to see what kind of bounce you got.
Okay.
Or three
Okay.
or
And now in your own account, now that you're
our
just
own
running your
mind, we're still trying to find a way to at least get a third of it out. It's
okay.
our
So a third is kind of like your get me out so I can like breathe and relax a little bit. And then the next two thirds, we're going to try to scale out on a bounce. Sometimes they don't bounce, so at least you got that third out, right?
yeah.
So okay, that
Remember,
makes
you only have a 5% position. So it's different than the folks today, at least the ones I see on Twitter that, you know, have huge commitments. I mean,
yeah,
if I had 25 or 30% in an individual stock, I wouldn't wait that long either. Like,
yeah,
but when you remember, you minimally got 20 names, you only got 5%. Maybe some of them have run up to 10. But the ones that run up to 10, remember, they've had to outperform everything else that you have in the portfolio. So those ones have been really super strong stocks. So it's a lot easier if you got smaller size, even at 5%, to wait for a bounce or a better opportunity to get out of something. You know
I
what I'm trying to say?
I think that is so important, because everyone wants to concentrate, and I concentrate a lot too. I try to spread it out, but I also I'm wired that way. That's the way Bill was, and I, but there's so much to be said for. I was talking to a buddy the other day or a while back, and he's like, with the money that he's running, he has a max of 5% for outside money, and I
Hmm.
said, you're golden. Like you're golden forever because it fixes 90% of the problems, because the pressure is that, when you have a stock, if you got 30% in it and it's coming down, you're doing the math of how bad that could be if it keeps
Oh,
going
yeah.
down. But worst case scenario, 5%, let's say it goes to zero. Your whole account got a 5% hit.
Yeah,
30% position, that's different, man.
you can recover from that pretty easily. So
Yeah. Okay. So now I want to go to the 1987. Oh, go ahead.
well, I
Sorry.
was I just wanted to make sure it was clear that when we were running institutional money, size really um, was a savior for when you got those kind of one company events where something bad news came out because it wasn't going to hurt the whole portfolio. So you could afford from a performance standpoint to wait to get some kind of bounce to begin your liquidation process. So it would be rare for us to, and even for me today, Mike, it's rare that I will sell on a bad day. I usually just will wait. Um,
Interesting. Well, yeah, that's something I need to work towards, and then one of the reasons why I want to talk to you is I want to learn these things that, and I think everyone out there should be really listening to what you're saying because there's so much to be said for experience, and I'm thrilled to be talking to you. So, okay, now I want to talk about 1987.
Okay.
So that year fascinates me. So the first part of the year is great. Then you're up 12. You end up 12% on a crashing year. Like that is gold. Like that is such a big deal. I put that, I would tattoo that on my forehead. So
Can I add,
wow.
through September of 1987, we were up 50%.
Wow. Wow. Well, that was such a people think 87 is a bad year. It was a great first half. I mean, that was a monster first half.
We were at, uh, it was a great year. So, so we gave a lot back, obviously. But
Uh,
no, I remember what's not only the event, we had NCR was in our office to give us a 225 million of their assets
oh
on,
wow.
on the day of the crash.
Oh wow.
And the chief financial officer, he was more interested in what was happening to the stock, and he said, "Oh, we're going to hire you guys. We'll wire them at the end of the week." And so that was our first really big client in 1987, and 3M hired us shortly thereafter, and then we were on the run. So
Oh, I bet. Yeah, because after
87,
doing
I have favorable memories, even though it was because my wife and I had been married. She was pregnant with our
was it
daughter.
your first kid or
So we lost one a few years ago.
yes.
Okay.
Yeah. And
Uh,
I'm sorry. I didn't mean to bring
no,
that up. I'm so
no,
sorry.
no, that's okay. That's probably the hardest thing I've ever had to do. When you lose in this case a son or a child, that's probably the most difficult thing, Mike. Because when I lost my parents, it was bad, but you expect them to leave, and you just kind of as a parent, you're a parent. You expect to outlive your kids and not have to go through that, but anyway, she was pregnant with Ashley. We just bought a new house. I'm in New York. The market, goes down almost 25% that day, and she's decorating the house. So I remember calling her up and say, "Cancel the decoration. We're not going to do that." And so I told her from then she could do one room a quarter to decorate. Uh,
Wow, that
yeah,
is so interesting.
we charged a percent for the assets or fee based wasn't
Uh-huh.
wasn't performance based. So your income stream just got cut by 25% in one day. So
Yeah, okay, so I get it
yeah,
from that lens, even though you're killing because of the way that the fee structure of instead of a performance, if you had a performance kicker on there, it would have been a
yeah.
much
No, the
di-
institutional market then was just you charge a percentage of the assets that you managed. So
got you kind of like RIAs do these days.
mhm.
So through 87, so you're up 50%. And walk through as much as you can remember every detail that you can remember of 87 and what the thought process was prior to the crash, during the crash, and just really fascinated.
Yeah, we started. This is what I learned from those partners, the 80. I kind of divide my career from the 70, 73 through 84, and then 80, late 84 through 2007 when I left.
Okay.
Um, so those are the two segments of my life. Um, so it was pretty. We're still talking about 87, right?
Yeah, 1980. So the question, and I'm sorry, sometimes I'm
Oh, that's
long-winded.
I was just
Like for 1987, so in September you're up 50%. In October you have the crash, and then afterwards, for folks who don't know, it crashed and then it kind of just bounced up and then went sideways chop and up for 88. But so from September on down, because I'll just tell you, I studied 87 so much, but never traded it, obviously, because I was still in high school. And it traced out just like 1929. I mean, it was like if you overlay them, the day by day is like identical. Were you Um, was that factoring in there? What were the things that allowed you to
Yeah,
still retain a 12% gain in one of the worst times?
yeah. Some of it was Mike. Just we had the leaders, but at that a number of years before that, we started using charts to also
Okay.
look at all the fundamental stuff. And as you may remember, things were starting to break down before the crash, and
Hmm.
see things. My memory's right. I think even the 50-day was getting broken.
Yeah. Yeah.
Close.
You had your top that came down and it broke, and you actually bounced up, and there was a follow through day that then failed right before it crashed.
Okay.
And so there was distribution up at the top, comes down, breaks like what felt like a big break, but it really, in the scheme of things, was just tiny.
Yep.
Comes up just enough to have just a little follow through, and then rolls, and then it just craters in what everyone remembers of 87. So
Yeah, we
prior
had.
to the crater, go ahead.
Yeah, I was going to say we had no special insight on that Monday, but prior to a couple of weeks, we were starting to lighten up as much as you could from some of the winners because we could see things were bending over, and it was, we were relatively new at using charts to help make decisions and cutting at certain moving averages. So I think a combination of that and just having such kind of outsized gains that what we had is what got us through there because it wasn't any magic. We just woke up that Monday morning. Got on a plane to fly to New York, and I walk in the office, and the rest is history. Because the first 10 minutes it didn't open quite that bad, and then it cratered.
What was that day like for you? Like, was it, because it's something no one had seen since 1929. So obviously, no one was really around and active in both time frames.
Hmm.
Um, so um, what was it feeling like? Were you in disbelief, like the quotes were wrong, or were you just, what was the thought process?
I think we were more numb. I don't remember us making any trade that day. Like
Wow.
we just watched. We just watched.
Wow. So that's probably why you're hardwired to not sell on a bounce or
Yeah.
not sell on a crash.
Honestly, we were spending more of our time with a potential client uh, who was walking around and explaining, going through his due diligence. And like I said earlier, he was more concerned about what was happening at his stock. Plus, he was calling his company, so we gave him an office for most of the day. And um, so it was just one of those events you just had to watch.
So were you
We,
still locked into you could only raise 25% cash at that point, or were you allowed to, in an extreme like
yeah,
that,
no,
have
that
more?
we, yeah, we, I'd probably say with half the clients, they would allow us to do that.
Okay.
So in those cases, I don't think we got to the full 25 because we just never moved that fast, Mike. But we were 15 to 20, which obviously was a big cushion compared to our uh, peers or competitors. So
Wow. So I would say from an outsider, it sounds like the your best defense was really that you had such a strong offense that you had the chips to give back because you had just been connecting so hard prior to it that
mhm.
when you came off the top, you were still having a winning absolute year, and on a relative basis, like you're like a superstar. Like that is no wonder why you got so many assets after that. Like, wow,
Uh,
that's great.
and then the couple of years that followed after that were our biggest years. And then 92 came is when PIMCO had an interest in us because we were of size that they thought they could sell it to their clients and get themselves into the institutional business. So we were probably almost 2 billion, maybe 2.5 billion when we went to PIMCO.
Wow. So what was that like going from, you'd said you started off with a couple 100 million when you broke off with your guys, and then going a couple 100 million is a lot of money, but 2 billion is a ton of money, and
Mm-hmm.
then eventually 11. But like the difference, did it impact you at all? I mean, obviously your paycheck is going off the 1%, so that's changing. But the way that you approach the market, was it more stressful, the same, or
Uh, looking back, Mike, I'd probably maybe the same, maybe a little bit more.
okay?
The difficulty was really could we implement that our process and have the activity that we did, or turnover, because when things weren't going well, we would blow it out. Could we still implement that? Because it's a relatively easy, hindsight, it's relatively easy to do with 200 million. You now got 3 billion, 4 billion, and up. It becomes much more difficult because the difficulty you get is you can't get out when you want to get out fast enough.
Yeah.
Because
It's like a Roach Motel type of thing.
that size, and if you got 20 names, I mean, you could do the math. It could take you 30 days or more just to try to unwind a position. So the more
Wow,
money
that's
you get, the more money you have, the harder it is, and you can see that in the institutional market today. That's why you can get these smackdowns, and then you'll see it just drift up. It just means the institutions decided, all right, I've sold enough for today or this week, and they'll just let the price drift up, and then when it gets to a certain level, they'll smack it again if they still want to lighten up in that position. So,
yep. I agree. No,
how much you had, for our style, the harder it was. And you could see that, if you looked at our historical numbers, in the early days, we were probably beating the S&P 500 by 40 to or 400, 600 basis points. And
that's huge. That's
towards
huge.
towards the end. But remember, earnings and momentum surprise. There weren't many people doing it, and uh, that's why I got attached to Bill and his work, because that's the place to be. I mean, there are times when it doesn't work, but if you can catch the leaders, you don't need too many of them.
Yeah,
Um,
no, the earnings momentum, and Bill would call it like earnings. The way he would look at it is earnings acceleration, like the year over year numbers go from 15 to 25 to 35. Like for him, he would, especially if there was double acceleration, meaning acceleration in quarterly sales as well as earnings, he would almost wouldn't care what the chart looked like. He would just say, "You've got this inflection point. It's going like this. It's going higher. Let's put it on our list and try to figure out a way to get into it, even if it's so far extended." And did you find that too? That even the stock could be really extended, but if it had that earnings momentum and surprise behind it, it was just people just had to go there, and so there's
yeah.
going to be a bunch of people like you buying it over a month or two.
hmm Yeah, that would happen. I mean, if we could find things that digit earnings, triple digit sales, we would just try to get as much as you can and just keep buying. But back then, our competitors on the growth side were what we used to call GARP. I don't know if they still
Uh-huh.
use that phrase.
Yeah, they still use that term, growth
They're
at a
a little
reasonable
more
price.
slower and steady, and we were, in high, what people would used to call us is more of a high octane man.
Hmm.
But because when things weren't working, we would just either blow it out or wouldn't add to it. Um, and so we were relatively new at that game back then, and so our performance, it's at least 400 to 600 basis points. But as we got size, that number would go down to between 200 and 300. So we were still able to beat the market, but not anywhere near the rate that we used to.
That's still, I mean, it's so hard to beat the market. People don't realize, and that's why you've got this whole camp out there, just dollar cost average into SPY, and it's really hard to argue against those
Right.
unless you look at some of the your really bad bear markets. But yeah, that's a good way to go because it takes so much work and effort to try to beat it, and you don't always beat it. And man, you guys were just really latched on to, I think, what is one of the right things. Now the other thing along those lines, because I started getting into earning surprise and no one else that I really knew was doing that, but I started looking at it and I noticed that you had acceleration in the earning surprise. The way we would calculate it is a little different than how you were doing it. Because let's say the earnings were supposed to come in at $1 a share, and it came in at a dollar 25. So that would be a 25% surprise. And what I noticed is you would get this kind of acceleration in the earnings surprise. So at first it would just beat it by 5%, then 10%, then maybe 20 or 25%. And that part was the sweet part. But then finally the analysts would ratchet up their estimates so far up that the stock couldn't match it, and then that's when it was over. Did you ever recognize that back in the day, or is that more of a new phenomenon?
Yeah, I think it's probably a little bit more new phenomenon. I mean, managements would talk to investment managers back then, and they would kind of give you hints. This is before all the regulations in the wherever early 2000s.
Yeah,
Um, so that environment was much more easier. Plus, stocks just didn't have these gaps up
no.
in ones that we have to do today.
Yeah, it's now it's just, with the Reg FD, for folks who don't know, that is basically the government went in there and tried to do something good, tried to make it so we all got the information at the same time, so they weren't giving it, hints out to folks. But then you've got these big gap downs because everyone's getting it at the same time, and it's this negative unintended consequence of the government with good intentions, bad outcomes. I think we'll try to not get political because I think you and I could talk for 5 hours
Yeah,
about that because we're cut the same way. But I'm trying to make it a non-political show.
yeah.
So, um,
And
so
then,
anyway, so you got through '87. You
mhm.
you lived through that. You guys get a bunch of assets. Eventually, you start working with PIMCO. And during that time frame, especially like, well, let's fast forward to like the '95 time frame, 95 to 2000, because that was this unique time frame that everyone is kind of equating to now, with even really 1990, 91 to, but really 95 to 2000, with the whole AI thing that's going on. What is your take on that, and having lived through and trading size during that time? There was, people don't realize how choppy the market was. If people just think '90s, oh, straight line. No, if
No,
it was choppy. So what was it like living through that? What did you learn that you could pass on to folks to help them if this is going to be an AI boom for years to come?
yeah, well, we learned in say 95, 96, and 97 on an absolute basis were excellent years. I mean, my memory's right. They were almost up 30% each of those 3 years,
That's awesome.
something like that.
That's
Um,
awesome.
but we were underweighted in oils, energy stocks in 95. And so we underperformed in 95, even though we were still up, say 30%. The market might have been up 34, 35%. Oils and energy, even to this day, I rarely ever do anything in that area. We used to call them too slippery for uh, our way of thinking.
Slippery when wet, huh?
We all have some certain biases, and I guess that was one of ours. Plus, the historic. I don't want to say they've never been growth stocks, but at least in my time, they weren't. But anyways,
Yeah.
so we underperformed that year. Um, but it was choppy, and I think '98 was probably the most challenging period for
Yeah,
us.
because that was that double bottom. It was Nasdaq was down 33% there, and then you turned and towards the end of the year, and then you go up in the straight line where everyone's probably waiting for a pullback, and that pullback that never happened. I mean, what was that like for you guys during that double bottom? If just refreshing your memory, you come down and you get the long term capital and all that stuff, and you undercut your first low, and then you just turn, and that's when Bill was buying, AOL and Schwab
Yeah,
out of their bases.
we were right there with them. So.
Okay, you were buying those too. So what was it? Was it more charts at that point,
That's
or
I still use Schwab to this day.
oh, do you? Okay.
I mentioned earlier, I don't know if that got on the recording. I have a tendency to use products that have those companies have been good to us. So
Yeah, no, I do the same thing. Like, I'm loyal to, if I've traded a company or whatever. Back when I was trading Apple, at the very beginning, my parents had always been Apple people because they were educators. But when
hmm
my dad retired from the Marines, then he went and became a high school teacher and basketball coach. And so they were using Macs, and my mother, being a teacher and principal, they were all using Macs, and I would make fun of them. I was like, "Oh, Macs are only for educators," and then when I started trading the stock, then I started buying everything. I bought from a shuffle to an iPad to an I bought every iPhone out from the first one, and I'll never stop using iPhones. It's because of the money that was made there, and my parents still own Apple that they had, that when I was trading an account for them back in the day, that they've held through that. So when when you're in Schwab back then, and it's had this lasting impact that you're still using it now, and that was 1998.
Yeah.
Walk through that trade. How did you find it? Would have been, fundamentally, technically, what do you think
Yeah,
was the
and it
what?
was new. So, in the small cap area, we were always looking for new and IPOs and stuff that was new. And it's something I still do today. I like stuff new that can really create alpha for you if you catch it right and you can catch that move.
Mm-hmm.
A lot of those newer ones that Schwab and some others, Mike, were new and they'd be on our radar screen and they had the growth and they were moving. And then we just used the same approach. Is we would always start with one. If it was working, we would just keep adding it to it because, as you describe some of those periods as being not only choppy but real difficulty. When
Yeah.
you, when you have time and you're not, remember we were never leveraged because you're just not allowed to do that in that marketplace, and you minimally got 20 names, and hopefully you got the 20 best names that meet your discipline. Uh, Unless the general market was the game basically then was as long as our relative performance was not worse than the overall market, you didn't have to worry about losing your business or half of it. Once in a while you'd get a client that just would cut the cord. I mean, because we all would lose clients once in a while for all kinds of reasons. But um, so when you ask me those questions about being difficult, in hindsight, it just to me the most difficult period I had was the 73, 74. Maybe it was because I was new. There was just no way out. Anything you bought wouldn't go up. Um,
Well,
so
having to be fully invested during a bear market that was like a Chinese water torture, just straight down, because I studied it so much, just going, oh my God, what would life would have been like? Yeah, every day is like, okay, I'm gonna be, unless you can go short, and it would have been too hard to go short because it was too late to short, but it wasn't, but it looked like it the whole time. It is like nothing you can do.
no,
Like that was if you could go back now to 73, 74 with the same rules that you had at the time, I don't think there's anything else you could have done differently, right? It's
there really isn't because I mean it was just one of the guidelines that the clients would have that you'd have to stay fully invested or as close to it as possible. With some exceptions, and you could have a minimum, and that's kind of how you protect yourself with minimum of 5%. And because even in those bear markets, you could have one or two that just wouldn't go down as much, and maybe went down 10 or 15%.
mhm.
Uh, if you're an individual who's trying to you know, develop cash flow as a trader, that's not the approach that's going to work for you because you can't ride through that.
Yeah.
So that's the advantage of for institutional marketplace. As long as you can find stuff that will beat the market in your bogey, but you still have 3 to 5 years. So if you can't do it in 3 to 5 years, in my view, Mike, you probably deserve to be fired.
Mhm.
For whatever reasons, your stuff isn't working, your style's not working. But even if your style's not working, that means it shouldn't be working for all your competitors either. So.
Yeah. So,
I mean, I don't want to mislead anybody that you didn't worry about this stuff because you're always worried about the assets that you were responsible for, but you had time on your size and on your side, and you had position size and that wasn't overweighted. Just what I mean, like
yeah.
you didn't
Well,
have
I get
25% of your assets in one individual security. 'Cause then
yeah, so go ahead. I'm sorry.
I said that would be. I mean, we weren't allowed to do it, but I could imagine what that would be like if you had that much money in something and it's starting to crater on you. You have to get out of it. You have to.
Yeah, you would now. Were you trading your own account in stocks at the same time, or did you have compliance reasons that you couldn't?
We would do some, but the clients back then, Mike, is we could not buy, say, Apple until 3 days until all clients had it in their portfolio. But
Okay.
the real difficult part was we had to wait 3 days after you exited it all.
Oh, yeah. Then it doesn't even make
So
sense to
we
even trade.
tinker around with stuff that we, more smaller stuff that we just wouldn't put in clients' portfolios. I remember
Okay.
we didn't have ETFs back in what 20 years of my first part of my career. I mean,
Yeah,
it
because
was
I mean, we started off with what SPY and Qs, right, in the '90s. So it was, yeah, it wasn't
used
until
weren't
like,
until like 99, if my memory's right.
yeah, I think, yeah, something like
But
that.
we didn't have that, so you could put it in maybe an index fund that was back then. Uh,
Great. So d-
but
going back to,
our
yeah,
income was being generated by fees at that time, not our own personal investment performance. So, you know what I mean?
yeah,
Yeah.
yeah, I do. So with the the lessons that you learned, because what the way I'm hearing you, I'm thinking that the genius was kind of how it was all set up. Because with you were set up for success with staying almost fully invested, or even if it's 25% cash, but still you're in. So the market timing aspect of it, that's kind of taken off the table, which is such a big part of things, because it's great if you can recognize a top, right? And get out, but then getting back in is so tricky because there's so many false starts, so many fall throughs, fail, or whatever you use. So staying in helps you there, with the rare exception of an '07, '09, or 2000, 2002. But most of the time, you don't have those. So 5% max, as well as the staying invested, like and still starting off with 1% with an eight. It's like you started off with the perfect rules. So it is going to be a lot easier to trade and a lot easier to match the beat your bogey
Hmm.
that way, because you've eliminated a lot of the pressures. Like a lot of the pressures that we had at the firm were, Bill, you just couldn't, you couldn't do that. Like we were gunslingers. He hired a bunch of gunslingers. He wanted you to be a gunslinger, and that's what we did. And so it's just I'm like just so envious because that seems like so much more fun just doing it the way you were doing it.
Yeah, it
Because
was. And then when I went, after you have just a little bit of history,
yeah,
we kind of had a falling out with PIMCO in the '99 period. So we severed the relationships, basically bought ourselves back.
because they didn't hire me. Is that why?
But that could be. That,
Yeah,
yeah, I was
probably.
looking around for a Mike Webster, and they said, no, we don't have one of those. I said, well, he's the guy that convinced me to use the 21-day moving average. I never used that until I met Mike Webster. I always used the 50-day.
Oh,
But
well,
anyways,
I,
no,
I
it was personality, going to a fixed income operation and an equity. And, they were, when we had about a year and a half of difficulty relative performance in that mid 90 period, they were kind of pressuring us to be more index like and just kind of find things around it, which is, my guess is how Bill managed the fixed income. He'd have his core stuff and then get the stuff around it to
yeah.
outperform. And it was just wasn't what we did, and we weren't going to change our style. So, anyways, after a few years, we bought ourselves back, and
Smart on your part. Really smart.
yeah, it was because the cultures just didn't match. I mean, equities and fixed income, and we tried to get into fixed income business on our own and failed at it also uh,
That's
earlier.
a whole different mindset, like,
Yeah, it's different. But we had some clients that wanted to, could you do a balanced portfolio for us? You do great on the equities. Could you do the fixed? And, we say, hey, we'll give it a try, and hired some people, and it just didn't work out. The mindsets are just totally different,
yeah,
at least
it
our.
is really, yeah, it's apples and oranges. It's a whole different, and just like commodities too. Well, commodities would be closer to what we do because at least it's chart based more than, yeah, that's a whole
Yeah.
different can of worms. What would you say, like, if you were talking to your grandkids, right, when they are of age to start trading, given the knowledge that you gained during all that institutional work, what would you pass on to them? Would you tell them to model it after the because I'm already thinking, like, I might do one of my accounts just and call it a Bob account and do it with this style, because Man, that would alleviate a lot of pressure, like, and I think it would probably do better than all my active stuff. What
And you can
what would you tell them?
still be active, Mike, because well, let me just. So we severed from PIMCO,
Hmm.
and we tried to rebuild it because we they took away 9 billion of the assets.
Oh, that's a lot. Yeah,
It
that's a
was
lot.
it was their money, their mutual funds, and we understood all that. And so anyways, we bought ourselves back. We rebuilt it, hired some other younger people because we were starting to get a little older. And my partners were 12 years older than I am. Um,
Okay.
so they're in their late 80s today. I'm 74. Um, and then so we rebuilt it, and then a firm called Principal Group. They're a
Okay.
big insurance company in Des Moines, Iowa. They were at the time one of the mid-sized leading 401ks.
Oh, okay.
And they used to have a growth manager internally whose record was terrible. So they came to us, and we came to an agreement and sold ourselves again. And my arrangement with that was 2006 was to stay for 1 year, and if so, I got my payout, and then I get a more payout if 98% of the clients stayed with us. And,
Okay.
and so in 2007, I went out on my own, which is just really me. I do it for a few other clients. Um, so what I was trying to explain is what I do today is I've kind of done a hybrid of what you guys do. So I get
Okay.
the markets now. So when we get the bad markets, I start scaling back, which is a huge advantage to not participate and just go to cash. I think I've only shorted once in my life. It's just something my mindset's just not fixed for it. So I'd rather just sit in cash and wait for things to get better. And then I'll still start with a 1% position, but if something's working, I can push it up to 20 pretty quick on my.
Oh, okay. So now you are going up to 20 in
I'll,
your own stuff.
but when I do that, if it's not working, I just start peeling it back. So that's the adjustment I've made since I've done my own thing.
Interesting. Okay, so you start off at 1% and then you're making it up to 20. So it's obviously a reverse pyramid that you're going. What
But I can.
pace would you go at?
I'm sorry. What was the?
What pace would you go at? So you start off at 1%, doesn't trigger your 8%. Are you still using an 8% stop loss, or did you tighten that up? Or
If it's a 1% position, I probably will linger around in that 8% range.
okay,
'Cause
so
it's not really putting a dent in what I do.
yeah, because yeah, it's so small. So now
Moving
it's
and running, I can just feed it all day long.
okay.
Okay.
So how many days, is it one day, a week, a couple weeks before you get it up to, let's say, from 1 to maybe 10 or 15%? What
Uh,
would a base case be?
if the stock's really moving, I'll try to think of a recent example. Well, Palantir was one. I went from 1 to 15 pretty,
Okay.
pretty quick, maybe a week.
Wow. Okay.
If it's moving, I'll just keep feeding it throughout the day.
Okay. So are you, I assume you're primarily an average upper,
Right.
like I am, right? So
Yeah.
as it's
If,
working for you,
if it's not working, I don't buy.
got it.
Right.
Okay. That's perfect. Now, what would your, now you've bought your Palantir, it is 1%, it's acting right. And so now you're ramping it up. Now you've got it up to, 10, 15%, and it starts wiggling and wobbling. At that point, are you using your average cost? Or are you using your highest cost? In like, how are you determining when to say, you know what, this one just isn't for me, it's not working out, and you're going to exit? Obviously, you have your 8% max stop loss at that point because it's bigger size.
Right.
But what is your typical exit? Is it the
Well, thanks
21
to you,
day, the 50, the
it's mostly the 21-day moving average is when I scale, unless it's so far extended from that. My,
okay?
before
That puts a smile on my face, Bob.
Well, before that, I went to a couple of your webinars. At that time, I had more hair and you had less.
I know I was a very straight laced,
Yeah, this was,
like
I don't know. Well, I went to your market school 2011.
Did you stay awake?
Yeah, I was awake.
Okay. Oh, so that was that at the Drake Hotel in Chicago?
Yeah, in Chicago.
Okay. Yeah, that was. I remember that. Were you at the very first market school one?
Very first.
Okay, I remember that. It was one of my worst nightmares in my life, because we had planned on doing. For those who don't know, we Charles Harris, Justin, and I came up with these market school rules because, frankly, what would happen is there's all sorts of reasons. Well, one of the frustrations was Bill would start. He never micromanaged us. Early on, he would let us just do whatever we wanted, and we all got out in the March 2000 top, and no one talked to each other. We all just knew the rules and knew what to do, and we just got out, and that's kind of how things went. And then after the '07, it was even before the '07 '09, he started looking. There was typically 10 PMs, all of us with different amounts of money, but he would look at the overall account, and if we were doing well, he would let all of us go in deeper. If that was doing poorly, he would say, no, you guys can't go in as deep. But it's really just the two big accounts that were controlling everything. So that was a disconnect, and we were trying to figure out, okay, we can't really tell Bill what to do. Right? No one tells Bill what to do,
Right.
so nor should they. So we were like, let's come up with some black and white rules on the market to tell us how deep in the market to be, because there were times where Bill was sending emails, not him personally, but he would call one of us and say, send an email to the PMs. Now we can go 67% invested. And then 2 hours later, now we can go 72% invested. There was one day I remember it was like 5 emails, like, so you're trying to navigate the market, and then you're also trying to navigate, well, this is what Bill is probably going to do. So let me get in front of that. And it was a nightmare.
Right.
So we came up with these rules, and it took us a long time. And we decided, okay, the only way to fund our research for it was to agree to do it as a service, and sell this um, uh, seminar, workshop, and then ultimately went to a home study. But so we're going to do this, and we're going to do it, I think, in like November or something. Mid year, it was like mid February, I think 11th or 12th or something like that. The market tops on the stalling day and comes down. Bill gets all upset that we didn't recognize stalling as collectively as a group. And so he takes Charles, Justin, and I off on this stalling rule thing, and it totally derailed us. So then we weren't, working on the market school rules. We were working on the stall rules, which is a form of distribution,
Hmm.
and he got really involved with that. And anyways, make a long story short, then they're saying, hey, we've got this great team of, I think it was the Naperville meetup group or whatever, was wanted an early workshop in Chicago. Can you do it in August? And we're like, okay, we could probably hit that. But we were so stressed, we didn't finish all the rules until just right before the workshop. So we didn't have time to prepare how to teach it. So we got up on stage, man, just knee deep in this research, and no clue how to. I wanted to crawl under the podium, Bob. I wanted to cry under it. Just go and cry. Like, why didn't we spend more time teaching it? It was all these blank looks on faces. Kathy Donnelly, I'll never forget her face, just looking at me like, what is going on? And Eve Boback and Ropel was there, and that was a nightmare. But everyone was kind about it,
Yeah.
and said it was good. But it was a train wreck. I,
Yeah.
I need to listen to. I think I've got it on DVD or
Oh, yeah.
something.
Yeah.
Yeah, or
No,
at least on CD. I think I have the audio, and
still,
oh man.
yeah, I still got your chart book somewhere. And then I went to the 2012 master's class.
Oh, okay.
Yeah, my wife and I were out there. We briefly met out there too, because you and her were talking about, it might have been Lululemon. There was a new women's clothing,
Oh, okay. It was probably Lulu.
and you were telling us that you had this little notebook that you would make notes about up and coming companies.
Yeah, yeah, yeah.
So, okay.
Yeah, yeah. No, what I would do is I would always keep a list of all the stocks. Whenever I'd hear something from someone, my Peter Lynch hat on, they would say like, "Oh, this is really good," or I'm having a hard time finding this thing in stock because it's so hot. And I remember going to a nurse, And I hate going to the doctors. And I went to a nurse in Santa Monica, and it was just down the street from where we did that level 4. And I'm just nervous, don't want to be there. And she's got these funny, ugly looking shoes on, the plastic. I'm like, just trying to make conversation. I'm like, well, what are those? And she goes on about Crocs. This is before they're public, and just going on. Everyone wears them because. I was just trying to distract from whatever I was doing there. And then when it goes public, I'm like, I remember that. So I did. I would always keep record of when anyone would tell me anything about that, because you never know when it was going to.
Yep.
And look at what Lulu ended up doing. That was a monster move, man. Really was. And yeah, I miss doing that. Those were so much fun. Like when you were there, like, wasn't it like
Yeah,
you're just like
I
part of a
was,
family?
yeah, I was trying to learn just what other people were doing. So I was
Well, you could have been there teaching us, frankly.
well, I was the student and you were the teacher. So,
Yeah, well, it should have been the other way around.
well,
Um,
uh,
so,
so
so anyways,
we probably all traffic in the same names, Mike, between,
yeah,
and yours. It's just that, um, we just did it by position size. And because we had time, if you know you have time on your side, that is a real big advantage because you just see how stocks move. And when the real big winners, you just have to hang in there for a while. Now, when I say hang in there, that doesn't mean you let something go down 50% and you lose half
mhm,
your money to hang in there. Um, and so what I do today is I'll just scale in and scale out. And I'll use, like when we came after April, I always try to identify the leaders and, stuff that's really moving. And I might just buy 21% positions. So when we came out of April, I had somewhere between 18 and 22 positions,
yeah,
all 1%.
yeah. I,
Uh,
I do I do that too. I call it my shotgun, and Bill would have shot me for it, frankly, if I did that. When I was doing some small positions, there he wasn't a fan of that, and there was a bit of a disconnect because it was my way of risk management of start off small. So I start off with 1.25, because then if it's not working, I can just back out of it and it doesn't hurt.
mhm.
If it's working, I'll double it up to a 2.5, and then if that's working, I kind of jump from a 2.5 to 7.5.
Okay.
Because I do that like I do the reverse pyramid, whereas
Hmm.
Bill would do a true pyramid where he'd start off with 50%, then add 30%, then 20%.
Right.
And there's advantages to that, and there's in disadvantages, and everyone's got to find their way. I'm more, in your camp of the reverse pyramid, because you're starting off and you're risking just a little bit. And, let's say it goes to zero, 1% for you or 1.25 for me. It's not going to hurt.
Yeah.
Um,
You're not going to let it go to zero.
no, of course not. I'm going to be out. I'll be out in three, between 3 and 7% max. Um, but so now you're doing trading exclusively for yourself since really 2007.
Right.
And what would you say, is it easier post oh 07? Now forget the oh 07, oh 09 bear, but great timing on selling, by the way, in oh 06.
As my younger partners are, I used to get some strange phone calls, let's put it that way.
Oh,
And,
really?
well, why did you leave? Did you have some knowledge? And, no, not really. But
Well,
that was
whoa.
a good year for me because I was pretty much in cash, and that was the only time I bought a stock that was under $10.
Oh, what was that?
It was a $2 stock called Force Protection. The symbol used to be FRPT. They're not in business anymore, so I don't.
Oh, I remember FRPT, but not when it was down that low.
Yeah, it was during the Iraq War. I mean, remember when they had IEDs and it was blowing up
Yeah.
everything, and our soldiers were losing limbs?
Yeah.
They came up with some kind of undercarriage
Oh,
that
okay.
the stuff would do it, and so
So like to put underneath the Humvees and stuff?
yeah, they put it all under there, and the tanks would roll over, but nobody would get injured, and it had just a ton of liquidity and a few. I used to never pay any attention to what other institutions were doing because we had our own style, and
Yeah.
But I could see after when I left on my own, I was kind of peeking around to see who would own it, and Fidelity kind of owned it, and I said, okay. Um, so I just bought some, and it quickly ran to 10, and it pulled back to 7, then it ran all the way up to 30, and then it pulled back to 20, and then it ran one more time to 28. And my experience is when they start running up and pulling back and running up, pulling back,
Yeah.
eventually it's toast. So I had a monster year that year just because of that one stock.
Wow. How what do you recall like roughly what size you would have maxed out in that? Like a 15% or
I went up to 20 because I had the
oh,
80% cash. And
wow.
I mean, I'm only focused on one stock, so I could do it. So
Wow, that's
I got lucky that year.
well, I wouldn't call that luck at all. I would call that you'd been in the business since you were 22 and you'd seen what can happen and you knew what to do. But I love how humble you are. You're a great role model for all of us. Um,
I could do, can I? I'll just share one little story.
sure, share anything.
How naive I was. I had, in the early days with the first firm, we had our approach and style, and then you had to go out and get your own clients after a while. So one of the paper mills, Mosinee Paper, hired me in 1975. So it was the first client I got on my own. And remember, we didn't have cell phones or anything. So I'd get a call and say, the board would like you to present your performance in Columbus. And I said, okay, sure. And I wrote down the address. And the meeting's at 10, and I'm in Columbus, and I'm driving all over, and I can't find this place. Remember, we didn't have GPS machines, so
Yeah,
I'm into a
they were
gas
like the Thomas Guide or
in
something.
a gas station, and we're looking at the map, and he says, God, there's no street like that in Columbus. So I called up the assistant of the fellow I dealt with, and her name was Therese. And I said, Therese, I can't find this place. She says, well, where are you at? And I said, well, I'm right across from the university. And she goes, what university? And I said, Ohio State. What do you think? That's the university in Ohio. And she laughed. She said, Bob, you're supposed to be in Columbus, Wisconsin, not Ohio. That's how naive. The only Columbus I know. Almost every state's got a Columbus. Well, when I heard the word Columbus, I just figured that was Ohio by Ohio State. Being a football player from my earlier days,
That is hilarious. I love that.
and so
Oh my
you
God.
make sure you tell Bob what state we're in for the future.
Okay. Bob, so if you ever visit me, I'm in Austin, Texas.
Mhm.
Okay. So so make sure you're in there. Oh,
I,
that's too
I,
fun.
I've grown up now. I know. Plus, I now have GPS to guide me. So,
There you go. I mean, people, yeah, the folks these days, they don't remember what that was like with the maps. You go down to AAA and you get your maps, or
mhm.
when we would travel with my family, we'd go down and get the little triptychs. Do you remember the
Yeah,
triptychs where
mhm.
they put that? Yeah, just yeah, it's completely different.
Yeah.
Um,
Well, that's my
yeah.
grandfather used to tell me, Mike. He was born in 1885. Uh,
Okay.
he was around. They were all my few generations. They were all farmers. My dad
Okay.
was non-farmer, and so they all grew up on farms. But it was before they had electricity, before they had
Wow.
cars, and so as a young boy, most of this is hindsight. But when I look back, how all that technology and evolution through time, and how the money was made, and Bill talks about it in his book with I think it's Bethlehem Steel was.
Bethlehem Steel, one of my favorites. That was
Yeah.
1915 to like 1916, and that was also the one that that was a high tide flag that was just like Taser, which was
Mhm.
Axon, in the '04 time frame. And I did a rambles on that one. And fascinating thing with Bethlehem was the the move that it had. That information wasn't out there, that they were doing secret contracts, with our allies, and that's why it was moving up. So it's such a you know I think you can learn so much from that it's always in the chart. Like
Yeah.
they knew, like the folks like you, the Bobs of the world in 1915, 16, they were getting the phone calls, hey, yeah, we're doing this.
Hmm.
And the smart ones were smart enough to recognize that, yeah, this thing is going straight up, but there's a reason and it's going to keep going straight up. And it did. It was one of the biggest moves
Yeah.
ever.
Well,
Oh man.
for the younger people in the audience, we've come a long way in our history because it's just my grandfather, not great 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 grandfather,
Yeah.
that he used to tell me that it was when in his early teens, it was rare to see a car on the road, mostly horse.
Wow.
And then like
Wow.
10 years later, it was rare to see a horse on the road, mostly cars.
What a weird feeling that must have been,
Yeah,
right?
that kind of change, yeah.
Wow. So like
Now,
the
my youngest son married a beautiful young lady, but her family's got one of the largest farms in the western part of the Illinois.
okay.
And he was just there, and he showed me pictures where he's driving a tractor. He's in the
Uh-huh.
financial business, so this is all new for him. But
Yeah.
the tractor drives itself. It's got GPS, and so it just does its thing, and it knows when the end of the property is, and it turns around and starts the columns
It's
before.
like a giant Roomba out there,
Yeah,
huh?
yeah. Mm-hmm.
Wow. That is
It's autonomous. You just sit there, and the tractor, somehow they program it in there, and it knows the plots of land and how far
wow.
to go. So
What are they growing out there?
soybeans right now, and they're
Oh,
just
okay.
I think about a third of it 3 or 4 years ago. They're trying to do organic stuff.
Oh, okay. Yeah, no, we're big into organic stuff in this household. I mean, I know you're very much into to health and things like that, and I do want to talk about that towards the end because I've got some questions for you that I'm just thinking of. But when it comes to your trading, like so back in the day, you had big slippage, you had big commissions. Now there's very little slippage unless you're in some really thin thing.
Hmm.
Slippage, for folks is just the difference between the bid and the ask, what you're going to pay if you just want to buy a market order or you sell it. That difference back in the day when I was trading, that was big, but back when you were trading, it would have been huge as well as commissions were when I started it was $28 a ticket plus 5 cents a share what which adds up a lot if you trade a lot. What about you, like back then, what was it like? And
It
the
was
transaction cost was a big part of your business, right?
it was different for institutional managers versus
Okay.
I'll say it's retail, because you can negotiate the commission rates with the broker. So you could go to Goldman and just say, "Listen, I want to buy this," and they would work the position for you, we didn't pay anywhere near the rates that you folks were paying back
Oh, okay.
then.
And you were doing the kind of like soft dollars, like you'll
So,
trade through them and then they will give you whatever in return, like, okay. So,
and then it became a little bit more difficult for us, like probably in the late '80s, early '90s, because all of a sudden the sponsors, the clients that had the money that they would give the managers, they wanted a part of the commission action. So they would say, we want to buy some services, if it was Quotron machines.
yeah.
So when you do that order through Goldman, tell them that they should journal over a certain percentage to that to whoever the X, Y, and Z client was. So our commission pool that we were using to buy all these services, the clients figured out that that was their money too, and so they put the squeeze on that way. So it became a little bit more challenging.
Yeah, no, I remember hearing about that and then things changed, well, I guess it was a while ago now, but like even more so it's more hard dollars these days. But
And I'd have to remember if we paid for your services through soft dollars or
you
not.
probably would have paid, most people paid soft dollars because then that's what
I
kept the
don't.
desk going, and so if your budget was like 250,000 with us or whatever, you just trade that much in commission and then you get your books and the NESMEs and all of that type of stuff. So what would you say for like someone who's starting out earlier in their career, because I'm trying to ask this of everyone who's, I'm doing these with, they kind of like in three segments. You've got like the people new, like the first 3 years of trading, the people kind of intermediate, like 3 to maybe 10 years, and then the folks longer, 10, 20, 30 years or so. Starting off with the new folks, what would like the one bit of advice to them to get them, to the next stage?
Well, if they're real new, the few that I've helped with is don't go too big position size. Just
Okay.
Just start small. I mean, compounding has a lot. I mean, if you, kind of my objective to this day is just to double my money every 3 to 5 years. So you need somewhere between 14 and 25% rate of return. And as long as you got a favorable market, I think that's doable, but
Hmm.
you don't have to do size. And if you're real new, today with ETFs, I would suggest they use ETFs and maybe just one or two stocks because if you catch it wrong and you don't have the discipline or you're not really there on your stop losses, Mike,
Hmm.
it can get real painful real fast. And my guess is most of them will freeze up or they'll put it into the long-term category and keep it there forever. So
Yeah, that I think that's the way the psychology
yeah,
works. Yeah.
yeah, nobody wants to take the loss. And it was, I guess, my understanding from the beginning is that the first loss is always your best loss.
Yeah, that's one of the best famous sayings ever. Some of the famous sayings aren't really worth worth what the words, but that one is.
Yeah.
So
So
I agree with that with the
I would,
ETFs because
I would do smaller size.
okay,
And if it works, you can feel free to add to it. And then don't be afraid to use ETFs. You don't have to use all stocks either in the beginning
yeah,
until you've tested yourself and you're confident that you can implement whatever strategy or approach you're using.
yeah. I still use ETFs a lot, but that's a different strategy from what you're talking about of starting out. But I totally agree because that built-in diversification just saves you from that single stock risk that the last thing you want is someone new to not know that they're buying right in front of a very important earnings release and then it gaps down 25% and then man, that's been there and done that and that's not
Hard to
fun.
recover, both psychologically and even financially if you get too big of a position.
Oh yeah,
And it's just math. You just can't. It just takes a long time to work through that.
it
Oh
really
yeah,
does.
that's what I would do is just stay small, use
Okay.
ETFs till you
So
prove.
about how many stocks would you say, like if someone's starting off in their first 3 years or so, would you say would be kind of an ideal type of thing? Like, would you say that the model that you did, your 20 stocks or your 5%, max, would that be something
If
that
you want to use individual stocks, I would probably have 5% max, 20 stocks, until you prove. You really have to just prove it to yourself. Who cares about what others say or think? But if you can make it work and you have the discipline and you're making money at it, then you can change some of those rules or size. But I wouldn't go too, particularly if you're brand new, Mike. I wouldn't go too. You don't need to either. I mean, you can still make a lot of money and with compounding,
e- e-
equal
e-
all size. Yeah. Now you're not going to win any U.S. Investing contests with that approach, but
yeah, that's a whole different. I mean, contest is a whole different thing, man.
yeah, I've never entered one, so I'm not sure what the rules are. But I see these 1,000% rate of return,
Yeah,
and I'll never have a year like that.
yeah. Well,
But I'll be in business the next week. So
yeah, exactly. So now talking to the people that have been around the block, they've proven to themselves that they know they're not going to be a deer in the headlights and in journal that gap down into their long-term thing and hold it forever. That they know what's going on, but maybe they don't have the super advanced, it's really just experience. Like the more years you're in there, you're like, oh, now I can file that away. It's like, oh, I've seen that happen and that's why I have so much respect for you. Like every year that someone can stay in the game, it's just you're learning so much. It's like artificial intelligence. The best ones are going to have the most amount of data, and you've got 20 years on me of 20 years of gap up and gap downs and this and that. It's one thing me going back and studying it 73, 74. I could look at this until I'm blue in the face, and I did, but you lived through it, and it's different. So to those people in that, 3 to maybe 10 years of trading, what would you say they should work on, like get this skill set down to kind of break that plateau?
yeah, I don't know if this applies, but the one thing I would add is don't add to a losing position. Uh,
Yeah.
I have my brother-in-law, he's a good person. He used to be in the bond pit in the 5-year pit, and he's trying to
Oh,
trade
cool.
stocks. But he's the worst trader in the world.
That's
And
funny.
I love him dearly because well, if I liked it at 100, I should like it more at 80. And if it goes to 70, I should even like it more. And
Uh,
that's just a fast way to lose money. So, at whatever level you are, I think the best approach is just don't add to a losing position. You either wait for it, exit it, come back another day. Um,
Amen to that.
it's,
Yes,
it,
that's
that
it's
applies to, I mean,
everything.
I do it to this day. I just will, I'll start with a one, but I just will not add until it works.
Yeah, the only person that I know that has been successful averaging down is Charles Harris. He does a great job. And I tried to do it one time or twice. Like, okay, well, what would Charles do here? This was early on, and some of the biggest mistakes that I made were doing that. Like, you have to be wired a certain way to be
Mhm.
able to understand that, and he's the only person I've ever seen be able to do that and do it great and have it give him an edge. Okay, so now we're going to go to the people like me that have been trading for a long time, but we're not at your level of experience and knowledge and just ability. So, what advice to help a Webby out, Bob? Help me out. What would you tell me that
That's
I should work on?
any
Because
help, but
no, I need help. Tell me.
well, there's a couple environments I look for, Mike. I love corrections
Okay.
of any size. I sometimes quote this study, and I have no idea if it's valid anymore because I haven't updated it since 2004. But generally, when the market fell 8 to 10%, 78% of the time, that was it.
Okay.
That was it. Doesn't mean no V shapes like we have today.
Yeah.
Whenever I got around that period, I always made sure I had a list of companies that I wanted to invest, and I'm always looking for, I used to call it feedback. The market's giving me feedback all the time. So if it was
Yep.
down like 8 to 10%, if I saw a leader, this is now where I use relative strength, where I didn't in the past. I would look for those, and I may just try two or three positions just with 1%. And then obviously, if it doesn't work, I don't add to it. But 78% of the time, that was it. So that's a time to get excited, and start looking, particularly if you've gone all the way, you're 100% cash. Um,
So how would you? So the market's come off, and what threshold were you using at least?
Usually 8 to 10. It was that 78% of the time. Now, remember this. I haven't done this
Yeah.
study for, I guess, almost 21 years now. But I think it's probably in that ballpark still today. At least that's how I feel. Uh,
Okay, so it's off. The
well,
market's off that amount, and you're in cash,
all right.
and now it's time. You're like, okay, this is probably going to be the odds are on my side. This probably the 78% of the time. What
Well,
what
the odds are in
signals?
your favor to begin to probe.
Say again.
The odds are in your favor when it's down that 8 to 10. You could begin to probe.
Okay, gotcha. Because it's kind of the air has started already came out of the balloon and everything, and now most likely it wants to lift at least to get back up.
All your leaders will probably at least pull back to the 50-day, if not worse.
Okay, so are you buying around the 50, or what would your in that situation would you be buying more breakouts buy down on the 50, something rounding out? What would your go-to be?
My today, probably most of my career, my breakouts to me are ads, not
Okay,
starting. My favorite position is something's coming up through a moving average. So if it's a real bear market, it's probably going to be the 200. Like that April one, it was more like the 50-day. So when
okay,
stuff's to come through, that to me is immediately a position to start stock. Because I know when I'm wrong right away, because if it breaks the 50-day. And then around the 50-day, I don't use hard breaks on the 50. I'll let price trapeze around it. You know what I mean? It'll kind of move around it. And
okay.
because I'm only starting with 1%, I'll give it a 3 to 5%. Let
Okay, so you're going to give it like that band there. So visualizing really like a three, you could just program it into your charting thing of like -3 to 5% underneath the 50, and then once it's getting down there, that's when you consider it truly breaking the moving average, not just okay, close 2 cents below the 50-day, I'm out. It's more, it's now does it have to just trade there? Does it need to live there, close there? What would,
If it lives there for about a week or two, I'll usually blow it out because it's just not ready.
okay.
But you remember, you know, when you go through corrections and stuff starting to move up through a moving average, there's resistance up there. That's why I use
Yeah.
the trapezing, because if I just use the 50, I'm probably going to get stopped out all the time.
Yeah.
But because I do start small, I can live with that 3 to 5%. While price is trying to figure out which way it's going to eventually break. And that's, you know, it could break down or it could break up.
Yeah,
Um,
I like that. What I've been doing more recently now is because I'm trying to get away from percents and I'm switching, trying to rewire my brain to think in terms of ATR, average true range, because you know a Palantir is going to be different than an Apple, you know, and is going to be different than a Cisco these days, you know, versus a Cisco in the 90s. So I'm thinking in terms of that of like, you know, is it one ATR underneath the 50 or something like that? But even more so, I would like to do things that I can just see on the chart in the high being underneath the moving average, whether it's the 21 day or the 50 or anything, for at least 3 days where it can't get back above, even touch it. That's my signal that, okay, now it's living under it. That's the way I look at it. And same thing above it. Like just because something breaks above the 21 day, I don't consider it above it. A low above it
right.
is it's starting to be, but really 3 days with your low above it, then it's truly above it.
Hmm.
What's your thought on that? Because that's something relatively new, you know, like over the last few years that I've been putting in there. I've been using the low above the moving average or the high under it for a long time, but this 3 day thing has been a newer thing. What's your thought on that?
Yeah. Since you've done that work, I've been using applying it. Let's put it that way to it. I'm probably not as precise as you are, Mike, because if I see something and it's starting to move up above the average, that's where I think size I have. I don't know if it's an advantage, but it's I can test things and
Hmm.
probe them and let the market give me feedback if I'm way too early or it's just not going to work out. So I pretty much just use that 3 to 5% around the moving average.
Okay. Well, that is great to know. Now,
That's
what
a
other?
I use your the low above the 21 day more for index than I do for
Mhm.
individual stocks. And so if the indexes are doing that, because I'll have that on my chart, I can see it from your work. And so if the market's doing that, then I'm just going to start looking around for stocks that are, and they could be coming up through the 50 or they can be coming up through the 21 day.
Yeah,
Those are,
I do like the coming up through the 50 thing. And that was something Bill was very opposed to that because we would get asked that question all the time. And he was adamant it's a no go. And so I was just wired like, you know, not to do that. But then the more I think about it, and so I've been incorporating this in my trading, is as you're coming back through, and I did that with Palantir as it was coming up and it made it through the 50 day. That's where I started buying, and I still have a position in it. But
yeah,
you know, it's you can just see that, like what you were saying, it should continue up. And yes, a penetration of it isn't the end of the world. It's whether it's 3 to 5% or you're high under it, it's something in that ballpark. um, so when you're scaling out of something, let's say you've built it up to a 10 or 15% position, and it's acting in a way that you don't like, and you start backing away, and it's taking you like maybe a week or something to get out of it. You're and you like to sell at least a third, you know, first probably. Do you ever then turn around and go, you know what, it's stronger than I thought, I'm going to start building those back? And if so, what would be those signs to get you to, you're going in reverse and going, trying to get this 15% position down to zero, but now you've decided, well, hey, it's down to 8%, I want to bring it back up to 12 or 15. Do you ever do that?
yeah, I wouldn't say often, Mike,
Okay.
but I pretty much use the same approach. I just wade back in. So if I had your 10% and maybe I cut it down to 2 or 3, but breaking through, say your 21 day, and then it
Hmm.
was finding support around the 50, and it was starting to do it. I just use the same approach. I just start feeding it back again and build it back up.
Okay.
It's not like scientific or special rules. I just see it starting to move in the right direction. I
So it's
still,
more of a feel and instinct type
yeah,
of thing.
yeah, but I'm looking at the chart. It's telling me that it's moving and it's moving above average. The only thing I don't pay attention to is volume. I never did, and so it doesn't mean much to me. So I
We're on
just
the
I
same
just look at the price action. Pardon?
we're on the same page there because I it would be a 4 hour conversation, but I used to love volume. Like I think volume is super. I actually think volume is super important. I just think that now between in a nutshell between no slippage, no commission, so there's no real cost for someone to put on a trade. The blow up in option market that
Mhm.
then
Yeah,
you've got a bunch of money that is not truly buying or selling. It's just hedging. The market makers hedging from there. You've got the ETFs. You've got the algos. You got like text reading algos. You just got short term out. You've got all this noise that, and you've got Reg FD. So you get these big spikes 4 times a year on earnings. I just go, there's no way, and with all the closet indexers out there, both hedge funds and mutual funds, that there's just really no way of
investment managers. That's become an approach too. Is the basically have the core part of the portfolio as an index and just try to add value with a few things around it. So,
exactly. So you add up all of those things, and it's just that this volume. It's just you don't know what the true volume is.
right.
Versus if you're going back when your great, well, not your great grandfather, but your grandfather in like 1895, if he was trading Tennessee coal, which was one of the big ones during that time, that volume was real because it was only on the tape. There was a true buyer or a true seller, and it's totally different now. But
Mhm.
anyways, I sorry I got off on that. But what other advice would you give to someone, anyone, a newbie, someone who's been around the block, or anything in between? Like, you have so much knowledge to share, and people should follow you on Twitter. I've always looked at your like the number of followers. I'm like, do people realize, who Bob is and what the information you have to share? Like, so share some of that and help us out.
Well, most of the stuff I post on Twitter, I mean, I'll do some market stuff and maybe some stuff that we used to do with the firm. A lot of my stuff is more on health. A lot of the spiritual stuff I post, I probably should clarify it more. Really applies to traders because
Yep.
it's stuff that you do. I mean, I have a quote on my screen that just says, "Your mind is a garden. Your thoughts are your seeds. You can either grow flowers or weeds."
Oh my God. I love that.
I mean, that not only applies to life, but it applies to trading. So,
That
uh,
is so good. Well, one of the people that you turned me on to was this, and thank you for all the kind
yeah,
things that you've given me over the years,
yeah,
including the Buddy Guy shirt. And my favorite thing that you gave me back in 2019, I keep up on top there. That
I,
the Eric Clapton book. It was
when
the
we
sweetest gift.
that will be the one. He's my favorite.
Oh, well, I named my son after Eric Clapton, so we're on the same page there. Um,
See,
but
that's the era I grew up with. When I was
oh,
listening to their music, nobody knew who they were, other than
oh, oh, how could someone not know Eric Clapton or Cream or the Yardbirds or
they were new. I think I might have posted or sent you. I saw Led Zeppelin in 1968. There were only 350 of us in the club that they were playing at. Nobody knew who they were. I was only 18 at the time, Mike, so I had to leave when they were done playing. But they stayed there and drank with all the people that were 21 years old.
wow, what year? So what year was that? Did you say
1969,
1969? Wow, so.
first coming to the States.
Oh, all the concerts I was going to skip that, save that for then, but forget
Okay.
it. We're going to do it now. So how many times have you seen Clapton? Roughly
I'd say 33.
33. Okay. So not roughly, exactly 33. So when was the first time you saw him? What was what group was he in? Was he solo at the time or?
Cream.
Okay. So okay. So
Not, I
what
don't
was?
toured here with the Yardbirds in the States or not. I did not see him when he was with the Yardbirds. I
Okay,
saw
so you
the
didn't.
Yardbirds when Jeff Beck was there and Jimmy Page.
Oh,
Uh,
really?
but I did not see Eric wasn't. I didn't see Eric with the Yardbirds. So
Now, what was the Yardbirds like when you saw that? I mean, Jeff and Jimmy are so different in their approaches. What were those shows like?
they were basically pop. I think that's one of the reasons Eric left him. Wanted to go more the blues route.
Yeah, he didn't like that "For Your Love" song,
Yeah,
the pop song
yeah.
that they did.
Well, that's what put the Yardbirds on the map, at least in our country when they came over here. That was their song. It might have even been number one for a while. So, but
Yeah, I think it was. So, were you more of a fan of, if I gave you a choice, Clapton in the Yardbirds, Clapton in Cream, Clapton in Derek and the Dominoes, or Blind Faith? So, which one of those groups
I
would you
like
say?
individual songs and probably all of them, but I liked him best when he was Derek and the Dominoes. I thought he had
Me.
the Beth rhythm section. Everything was just perfect for my ear. So,
Well, again, up there, what's next to the book that you gave me?
Layla,
Layla.
you're looking at it, I can't.
Yeah, that's like that up right next to it, because I know it's probably hard to see the book that you gave me, and then we've got the Layla thing, which is I think a perfect. There's very few perfect albums, and I think that is that
Yeah,
it's in them bringing Dwayne in, was just the perfect mix, right?
yeah.
Like they needed that.
He was a fabulous player. I mean, he's another musician that left us way too soon. Uh,
Yeah, that was
yeah.
I think a motorcycle crash, right?
Pardon?
Wasn't it a motorcycle
He
crash?
was in a motorcycle crash. Yeah, he was only
Yeah,
like 25, 26, 27, somewhere in that
something
range.
like that. Yeah,
Kind of like Jimmy was that
yeah,
range.
yeah.
Yeah, in my youth, my guitar teacher toured with the Allman Brothers for a while.
Really?
Yeah, we had a lot of really good local musicians. He had a group called the Crying Shames. They had a couple number one songs, but they just couldn't get past the all the British people that were coming here. But yeah, we used to we in my youth we used to have battle of the bands. They were at movie theaters up and down the different suburbs.
Uh huh.
We were never really good, but we thought we were kind of good. We had 12 songs down, really pretty good. That was about the extent of it.
Remember you told me "Walk the Dog" was one of
And
them.
Walk the Dog, Route 66, when the Stones did that was another one.
Great song.
Wayne Cochran did Last Kiss. I like
Okay.
Pearl Jam Vision or version better today. Let's see, a song called Louie Louie. I don't know if you
Oh
remember.
yeah, of
Remember these?
course.
Yeah, these songs were basically 3 to 4 chords.
Hmm.
Um, I mean, I can still remember Last Kiss. It's just G, E minor, C, D, and you just repeated it throughout the whole song. So it wasn't like you had to be great musicians. Plus, we're 14 years old, but we were at a club called the Cellar, which is in a little town called Arlington Heights, just north of where we lived. And we were watching this kid play, and he was maybe 3 years older than I was. And that's when I said, maybe I shouldn't be a guitar player. Maybe I should go back to athletics and stuff like that. And I said, well, who is this guy? And they said, well, he just moved here from Detroit. His parents moved here, and he's got a little band. It was called Ambi Duke Boys. It was Ted Nugent.
Ted Nugent. Wow.
So, so here I'm 14 thinking I'm a decent guitar player
Yeah.
at the time. And I see this kid up there, a kid at the time, Ted, he was doing things I just never dreamed of doing. So in my era, you knew all these people because they were just local kids, just like we were. And you maybe knew him before, but remember Terry Kath, the guy from Chicago?
Yeah. Well, Hendrix said that he was the best guitar player.
Yeah, he did say that. But
Well,
those,
speaking of Ted Nugent, distinctly remember the first time I heard Ted Nugent, because I was driving and I heard "Hey Baby," and I'm like, I've never heard this before. It's so good, and I pulled over and use a payphone to call, kids. That's these things that used to be out when you didn't have a cell phone, and I called up KLOS and asked him, "Who is that?" And the guy's like, that's Ted Nugent. Like I'm an idiot. It was like he's so good, and he is such a character. And I
Yeah,
remember that's what Clapton said about the first time that he heard Stevie Ray. That he said that when he heard Stevie Ray, he needed to find out that day who that was on
yeah,
the radio.
yep.
And now, did you see Stevie Ray?
Yeah, I seen him. In fact, we were at the concert at Alpine Valley on Friday night. Well, we
Oh.
were there to see Eric, but Stevie would play before him,
Mhm.
and and then that Saturday is when the incident happened. So we were there Friday, so we got to see him. So I saw him the last time he played live. So
Wow, that's so. What was it? So, Buddy Guy was there, right? And was Jimmy Vaughn there too? Or, no, I
uh,
don't think Jimmy was there.
he might have been playing with Eric in his band.
Yeah, might have been, but well, that what a
He was just awesome, Mike. I mean, I never seen a guy who could do what he did on a guitar, and at the speed he did it was
just
just
amazing. And it's so sad that he had gotten sober, right? And he would finally he had been into heroin and everything and drinking and I know how hard it is to stop things because it's
Mhm.
maybe like 854 days ago, not that anyone's counting, is when I stopped drinking and I stopped,
uh,
anything bad for me, to get on my health journey, which you're a great role model for. And it's, man, it's really hard doing that. But I wasn't addicted to heroin and those
no,
types of things like he was. And then to see him go like right after that, it's just,
yeah, it was just a tragic accident. I don't know. The pilot just, it was, from what I'm told, it was a cloudy night, and he just went to Alpine Valley. I don't. You've probably never been there,
no, I've
but
never been there.
it's a ski hill in the winter, and so
Okay.
it's I don't know, maybe 150 feet. It's not like skiing out west, but it would be down and then it would flatten out, and they have the stage down there, and if you were lucky, you could get close to the stage. Otherwise, everybody's just backed up all the way up
Oh,
the hill. I mean, it's I don't know, 20,000, 25,000 people it'll hold, so it's a big group.
yeah,
Yeah.
that's a big place. Wow. So now
I was
you,
there when she was pregnant with Ashley to see AC/DC, and we were in the second row. So she's
oh,
on
second
stage
row.
there, just the music's just
Oh my God. That is great. How far along was she, do you think?
8 months.
8 months. Okay.
So she
That's,
does our daughter have to have that music? I said,
that's a little bit rough, man. An AC/DC concert at 8 months. That's
yeah,
some hardcore. So what
hold on.
album would they have been? What year would that have been?
88.
88. Okay, so what would it have been? Can't remember what album that would have been in 88. But they're just as Angus always says, like all their albums are the same. They just change the cover, and they're the only people who can get
All right.
away with that.
Now,
I
you remember the first record you ever bought? Not that you heard, that you ever bought for yourself?
Oh yeah, it was Queen the Game.
Oh,
I was living in we were living in Virginia in Quantico at the Marine base, and I rode my little bike down because I just had to get this cassette. I don't think I
yeah.
still have it, but it was, man, I was like I've got to get this. And then not too long after that, I was really into Dirty Deeds Done Dirt
Well,
Cheap.
sure.
But I thought it was I thought it was something else. I thought it was the Dunder Chief or something. I didn't know until I was an adult that the words were
Right.
different. What was your first one that you got?
Well, the first actual record I bought was Chubby Checker, The
Oh
Twist.
yeah, Chubby
Yeah,
Checkers. Yeah,
yeah.
the twist.
It'd be 1961 or something like that. So I might have been 10 or 11.
Oh, that's awesome. Yeah, Chubby Checkers is great. Like,
Yeah,
we're both into that old stuff, like,
yeah,
Buddy Holly, Elvis,
yeah.
Chuck Berry. I mean,
Oh,
do you remember the Hail Hail rock and roll movie with Chuck Berry and Keith Richards and Clapton? I mean,
yeah, that was a great one.
that was
Still
so
listen to
good.
those clips too.
Say again?
I listened to that clip also with Chuck, Eric, and Keith.
Yeah, there. I mean, it was yeah, and then Chuck getting all mad at Keith. That's hilarious. So
We grew
what?
up, we grew up with Muddy Waters, towards the end of his life, lived one town away from us,
Oh, wow.
yeah, in a little town called Westmont, Illinois. And as a little boy, I would caddy at a golf course that was just beyond this town. And my guitar teacher sometimes would play with Muddy on his uh, what do you call this, a porch in front of his house.
Wow.
I'm a little boy. I got to watch him every once in a while play.
No way. I've looked at Muddy's house on it. It was kind of a narrow one, right? If
Yeah,
I'm not
that one
mistaken.
in the city I think was more narrow. This
Oh,
he
okay.
moved out to the suburbs at that time.
Oh, okay. So, how many times did you see Muddy like on a stage setting?
Never, I never
Never?
see him on stage. No, I was
Okay. Now,
too young.
what about Buddy Guy, who we're both big fans of?
He's probably up there with Clapton as many times. I mean, almost every January, I go to his club because he goes there, he plays there in January. And then he, about every other year, he comes up north. There's a arts and music school called the Interlochen School, which
Okay.
Barb and I were fortunate we've been able to help the school along financially.
Oh,
Uh,
that's nice of you.
it's just a wonderful place, and they have all kind. I mean, we see Johnny Lang there, and
Oh,
Steve Miller goes there. Steely Band goes there. Buddy Guy plays there about every other year. I mean, it's an arena that sits between two lakes. It's got a cover on it, but open side, so you kind of look at these lakes. The stage is
ah,
there, and it holds like 3,500 people. So you're not going to get you're not going to get an Eric or the Rolling Stones to play there.
yeah, but still 3,500, like the 2,000 to 5,000 venues are the best because even the worst seat
Yeah.
is a good seat. You mentioned Johnny Lang, who's probably the person I've seen the most. I must have seen him
Okay.
at least 40 times. I don't know if you know this, but it was January of maybe 4 years ago or something like that, that he has because I have a vocal cord disorder, but his vocal cord went where he's done now. Like he has, and I search maybe every month for news on him. If anyone out there ever hears about Johnny Lang, man,
I wasn't aware. I haven't seen him play probably 5, 6 years.
yeah, that's why. Because I'd see him every time he was in town, and if he was and if he was in a few different places, I'd drive out and that's if he ever comes back, he's one person who's got a positive message. Reminded me a lot uh, uh, of BB King in the message that he would choose, a very positive one, and just such a great singer and a great guitar player and a great entertainer. Every time I left the concert, you know how it is. Sometimes you go to a concert, you're like, okay, I checked that off the box. I needed to go see them. It's been a while, saw them. If I don't see them for a while, it's fine. With Johnny, every time I was like, I cannot wait to see the next
He
time.
was good. He put on a great show for it.
Yeah. And the great part about him is
Steve Miller puts on a good show too. I don't know if you've seen the Steve
I've
Miller.
never seen Steve Miller, but let me tell you, Steve Miller, I became a huge fan of him because of Jan and Dean.
Mm,
That this is the weirdest thing.
yeah.
Growing up, I was into the Beach Boys, and it's sad that we just lost Brian.
Yep.
And Jan and Dean is in that category. So I went and I bought a cassette, and it was in this one. It was in a dollar bin, and I was a kid, and it didn't have much to, dollar. Every dollar is a dollar, and I bought it and listened to it over and over again. I'm like, Jan and Dean is great. Jan and Dean is great. Well, fast forward, I'm at a college party, and we're all drinking and all that stuff. Or mom, dad, if you're listening, I wasn't drinking, I was just drinking water. um, but it was all of a sudden they start playing Steve Miller, and I'm like, oh, it's Jan and Dean, this is great. They're like, what are you talking about? This is Steve Miller's greatest hits. I'm like, no, it's Jan and Dean. It turned out the little cassette I had, somehow they put the wrong tape in it, so they put Steve Miller's the what was it, the 74 best of, or whatever his famous best of was, in that cassette, even though the outside of it said Jan and Dean, it was actually Steve
Mm.
Miller. And so I've been a fan of his since I was a kid and didn't even know.
Even to this day, he puts on a good show. So
I've seen some clips online, but I need to go
yeah,
uh, to
he's a
see him.
Midwestern boy when he grew up. He was in
Say
Milwaukee.
again?
He was a Midwestern boy. he's probably 5 or 6 years older than maybe 6 years older than I am.
That
So
sounds about right.
yeah,
Yeah.
he was raised in Miami, not Miami, Milwaukee, and trying to remember who was real influential on him. Maybe it'll come to me. I don't remember, but it was somebody that we should all know.
Yeah, he's great at just like kind of the pop fun songs, you know. It's not going to be an Eric Clapton something deep or anything. It's just it's always fun to listen to
Yeah.
him. So besides Clapton, what other concerts would you say like if you could go back and relive like two or three concerts that you saw, what would you say those would be?
You mean different bands than
Yeah,
Eric?
different. It could be Clapton. It could be a specific, you know, maybe the Cream or whatever. But if you could go back in life and you just go, man, I wish I could relive this experience. Maybe your top one or two.
Well, it would probably the first one or two would be seeing Led Zeppelin again with only 350 other kids. I
Can't
mean,
imagine. And you know
it's,
what shirt I've got on. I don't know.
yeah, yeah. It was a little place called Kinetic Playground. It was up on the north side of Chicago, and yeah, I might have posted once. They just
You
have.
did. You posted a picture of it. I thought it was in a high school auditorium for some
I was
reason, but
back there playing. Yes, I'm only 18 years old at the time. But just to see those guys that close, I mean, because there's other arenas where people just put on excellent shows, but when you're physically that close, where you could just basically touch these just fabulous musicians, I would probably
wow.
put right there at the one. Then they were called Chicago Transit Authority, which then became Chicago. With Terry
Hmm.
was I would like to go back and hear them. They were the first ones to introduce horns. I don't know about first, but real early into that kind of music.
Yeah,
And so
and the horns just really worked with everything, didn't it?
it worked with everything they did. It was
Yeah.
just new and different at the time.
Yeah, I
Uh,
never well, see, I never thought about that being the new and different, but like so what would your favorite Chicago tune be, do you think?
Probably the one I sent to you, that 24.
Yeah.
Uh,
Yeah.
he's this phenomenal lead in that when he goes to do his guitar thing in that.
Yeah, he and I don't know if you've heard, but Marcus does a great version of that
No, I
too.
haven't. Okay.
Yeah, it's on one of his EPs. He does it along with a couple other songs. He kind of does a melody or where he meshes three songs together, and he does that one on it. I think you really dig it. I'll send it to you.
I saw him, and he's of the newer musicians. He's one of the favorite ones I would love to go see again. I've only
Oh,
seen him once, so
yeah, I he was the first last concert I saw before the COVID lockdown, first concert since, and I see him every chance I get. I mean, I've seen him this year a couple times already, and I, I'm, I'm man, he's the new king. Like, look, we lost Freddie King. Did you ever see Freddie King?
I never saw him live. No,
Okay, or how about Albert?
Albert,
Did
I've
you?
seen. You
Oh,
know,
what was that like?
my buddy guy would have all those guys come through his club occasionally,
Oh, okay.
so that was always a natural venue for us to go to.
So now the legends,
Another small.
how many times did it change location? Because it was the checkered or the Buddy's place. Just walk through the history. Was it just the two locations?
Two that I'm aware of, unless there was something before I was into music or knew about. Yeah,
Oh,
it's new, and he what is he, 88 now?
I think so. And
He just,
a new album is coming out this month.
I haven't heard it. Is it coming out this month?
Yeah, I think it's this month that's coming
He
out.
does a good show, and you've seen him. You know his personality and what he likes to do. But he would take his guitar and just leave his club and go out on the street. Because you got wireless today, and
Yeah,
so people just walking on the street, and he's just out there. We'd have cameras when we're in the club, so that you could see what he was doing out there.
that's
He's
all.
out there just doing his thing, and he puts on a good show. But if you're ever in Chicago, it's a great place. He just has wonderful blues people play there who we've never heard of. But I mean, these are excellent, excellent players. I'm sure you
Well,
get a
I
lot of that in Austin too. But
yeah, I need to make it up there for one of those January shows. The weather's pretty bad up there that time of
Yeah,
year, I would imagine.
it's nasty. Yeah,
Yeah.
it's nasty.
Well, wow.
Particularly,
So you've seen so many shows in the Led. I just can't even wrap my head around seeing Led Zeppelin in with 300 people at their prime. Like it's just it
basically,
doesn't commute
young kid.
compute about how good that is. Like that's like oh my god, I can't imagine. Oh, what
Uh,
would your favorite Zeppelin album be?
I don't know if I really have a favorite, Mike. I just like them. I almost like them all.
But they're
I,
also different, right?
yeah,
Each one is
they're all different. I don't know if I could pick a favorite, to be
okay.
honest. Yeah, on I
That
mean,
would be a that would be a tough call for me too because it really depends on the mood you're in. Like even like in through the outdoor, which
mhm.
I don't think anyone would say is their best. There are times like that's an album that you can just put on from beginning to end and just loop it because it's just a fun album. And I think John Paul Jones had a lot more impact there. And it just was it was kind of a complete disconnect from like
Yeah,
physical graffiti or all the way down to the first four or anything.
yeah. For me, that's something I could listen to through. If I'm just kind of in my office on a trading day, where I
Hmm.
can just put it on Spotify and just kind of listen to it and get in the
Yeah,
for it.
it's a fun it's a really fun one. Well, I
How
did
about Peter Green? Did you ever get into his stuff?
no, I never well I probably know more about Greenie, you know, the Les Paul that then that uh,
Oh, excuse me. Les
Kurt.
Paul was the one who taught Steve Miller how to play.
Oh, it was Les
They were
Paul.
neighbors. Yeah, I couldn't remember the name until you just said that.
Oh, so why don't you tell the folks that won't know the story about Les Paul's car accident and his arm and everything, and because
I'm
that's
not
just
sure I can tell
fascinating.
the story, but all I really know about him is that he was the one that taught Miller and was the one who encouraged him to pursue it as a career.
Oh, okay.
Yeah.
Well, so Les Paul, you know, one of the, you know, big inventors of so many things that people
Mhm.
don't realize besides, you know, obviously the guitar stuff,
Yeah.
but he had in someone who would know the story more than I was probably going to correct me and that's fine. But my understanding is that he had this terrible car accident and it messed up his arm and they he told them to set it in a way must have been this arm
Oh,
his right arm
good
in a
catch.
way that he could still play like so it was broke completely broken but then it wasn't going to be able to move but he wanted to still be able to play and I mean if that's a true story and I believe it is that's a diehard guy for you. I'd like tell the doctor put my
Yeah.
arm the wrong way so I can still
I haven't-
play guitar.
I didn't hear that story. I,
Okay, well, hopefully,
obviously, I know who Les Paul was
of course.
as a little guitar player, but it was the idea that he was the one that encouraged Steve Miller to pursue his career, and he might have even taught him how to play some stuff. And then
Oh wow. Well, if you watch, you know, if folks watch footage of Les Paul, I mean, he was a shredder. I mean, he was really good. It
yeah,
wasn't just his all the stuff that he created. It
uh,
was that. Now, did you? Now, you never saw Buddy Holly because that was
Austria.
1959.
Yeah,
Yeah, that would have been
parents,
before.
yeah. I listened to his music, and my parents loved music too. So as a little boy, I could hear all that stuff, but I never, obviously, didn't get to see him.
Yeah, that was.
And I never saw Elvis live either. I never did
Oh,
get to that.
Elvis would have been.
Yeah,
Oh, I was.
all those people were on. See, when we were also growing up, it might have gone leaked into a little bit. You might have been a little too young. You had the Ed Sullivan Show. You get exposed to all the great musicians coming up. There was a show called Hullabaloo. Might have had Goldie Hawn was on there.
Okay. It's
Shindig,
the Dick Cavett show, right?
yeah, and then Dick Clark, the
Okay.
bandstand. Um, so we got exposed to a lot of music through that stuff. I mean, as little kids, you would just gravitate right to your black and white TV and watch all that stuff. And
Oh, back in the day before there were remote controls, you
yeah,
know?
there was
Yeah.
nothing, and there only had like 4 or 5 channels, and they went off at
Yeah.
2 o'clock at night too. They didn't go back on until 6 in the morning.
Ex- Exactly. I remember when our little TV dial broke. You know, it would be my sister and I. We would be in charge, and I think we probably had some needle nose pliers to go in there to
It's,
change the channel. Um,
Aaron
but
was one of those things you just would adjust like this to see if you can get a clear picture.
Exactly. Yeah. I think I actually saw my first chart ever on by accident on it was a remember there was the normal TV, but there was also like it was a weird antenna. It was kind of like a U-shaped
Mhm.
thing for like UHF or something like that that would bring in some local channels, and I was dialing it around trying to get something, and there was some guy on there with some charts, and he was just going through, and he's like, and I was just a kid, a teenager or something,
Yeah.
and it's like, oh, this is support and this is resistance, and it just goes from here to here, and it's that easy, and I'm that filed away in the back of my brain. Um, God, I hadn't thought about that in forever. But well, you know, one thing I'm sitting with this, and you've had such a big impact
Yeah.
on my life in so many ways that you don't know, and you're such a positive influence. And so this the David Hawkins that you turned me on to really, you know, the one book that really did it for me was that pulled it up earlier, Power versus Force, that
Okay.
you told me to read. In it, I'll just tell you, I had some hardcore beliefs on some things that I don't want to say what they are because then it will ruin it. But that I thought there was no way that anyone with any amount of money or motivation could get me to change my mind on. And I read that, and it wasn't the intent to change it. But after it, I thought back through and I changed a kind of a core belief of mine. Um, and so it's so super powerful. But so tell me about that, how you got into reading his stuff and what you got out of it, because it's so powerful.
Yeah. Um, I, I went to one of his seminars when I was probably in my 30s, Mike. I just wanted to learn as much as I could beyond the investment stuff.
Uh-huh.
He had a seminar in Arizona, so I said, I'll just go to it. I'll see what it's like. And then I got turned on to him. He was he developed, as you know, in the book, he developed a methodology to kind of determine truth versus falsehood.
Yeah,
And
maybe I could explain it in a way to someone who's never heard about him. Because until you, I'd never heard about him or all the ways that he measured stuff, and it's fascinating. I think people will find it fascinating.
I'm not see if I can do it justice. As all of us enter this world, we're born with a certain level of consciousness. Um, and if you're below a certain number, it's more about survival instincts. So that everything that you do, and it has nothing to do with your status, amount of money you make. We've had political leaders who have low levels of consciousness. And so it's kind of something you're born with. And as you go through time, you can raise it or lower it. It's I'm not sure I should go through all the numbers, but there's different levels,
Hmm.
and so most of the population is at what we would call survival instincts. That's part of the reason that we have, all the issues with crime and everything they are, because it's they're just doing really the best they can. So you don't want to. I don't use it as a judgment thing,
Yeah.
but I'll use it as, well, maybe that's somebody I should stay away from, or maybe that's somebody I won't do business with.
Hmm.
Um, Once you do these calibrations, you could either do it, through, it's basically kinetic energy. And so you can go from a very low level, you can go to a level that's, uh, I would call it integrity, where somebody, it doesn't mean you can't still do bad things, but it's integrity. And then you can go all the way to the level, like he's got a rating system basically from 0 to 1,000. There's only three or four human beings that ever have gotten to 1,000. It's Jesus, Buddha. Who am I missing?
Those are the two I was remembering. I can't remember the other one either.
There's a few. We're they're just on a different dimension and different domain as most humans. In fact, most humans can't get past a certain level because our bodies can't handle the energy. Um, and that in his belief and others' belief is this isn't the first time that we've been here, that we come more than once, and that's the purpose of life, is you're trying to move up the scale until eventually you get to a point where you don't need to become a physical being, you just stay a spiritual being. Maybe you'd be an angel, or I have no idea what happens afterwards. So the part of the belief system is that through evolution you can raise your level of consciousness. But and you can test anything. In some of his books, he's got political leaders, he's got liberalism versus conservatism, and you can see that some political beliefs are in that survival instincts. That's why some politicians do what they do. Yeah, I just really got turned on to it, Mike. But again, for those that have an interest in read his book, the key thing is you don't really want to judge people by it.
Exactly.
Because they're really just doing the best that they can, given that their makeup and consciousness level. But you can use it if you don't want to do business with somebody, or you just say, that's I just don't want to be anything. He's got I don't know if it's a famous quote, but you don't ever want to go to peace rallies because peace doesn't happen at peace rallies.
That's a good line. That is such a good line. Well, I do think folks should look into them, and with an open mind. And
For
it
those, he might have some stuff on YouTube. He's since passed away 8 or 9 years ago, maybe a little longer than that. But his whole story is just a phenomenal story.
Yeah,
And
I found that book fascinating, and in if you really, what my goal was after I read it is going, okay, my level of conscious, where I was, I just wanted to move up. I wanted to make sure I didn't move down, but I really wanted to move up because I felt like, you just want to be a better person. And the way I translate that in my mind is, whether it's right or not, is just being kind and trying to put positive energy out there, and trying to help others, which is one of the reasons why I'm doing this program and putting these things out. Is I just want to try to help people,
right.
and and of course have something for my kids and my
Mhm.
future grandkids to learn from. But yeah, thank you for that. So now I think it's time for us, because I know you got to play with your grandkids, to do what my favorite part of these are. I'm going to ask you some questions, and
I can.
the concept is, back when we were growing up, you would get around with your friends, you say, oh, if you're trapped on a desert island, which album would you bring, which this would you bring? So it's kind of like that. It's, if you were only allowed to listen to two albums for an entire year, even when you're like in an elevator or whatever, that music is playing, you get into wherever, this is all you can listen to. One live album, and it doesn't have to be the same artist, and then one studio album. And that studio album cannot be a best of, but it can be a double album. So we're going to start off with the live album. What would be your favorite live album?
Well, recently I'd probably say Eric at the Albert Hall. The recent one.
That's so the 21 nights, or the more recent.
The recent one, 21 Nights, would be a great pick also.
Yeah, but that was what,
I
mid
love
80s.
all the versions of everything he did, from you know, Layla, Crossroads, and the introductions. Do you remember the Crossroads and how he's just playing this little thing before he gets into it? And
Yeah, the intro stuff is like the best, and that's always been my favorite thing with him. and
I think he
and
did Holy Mother on that one.
I think so. And that's one of the heaviest. You remember the Holy Mother that he did with the
Oh, the Italian singer.
the Italian guy. What is
Uh,
his name?
my wife loves that. We play that all the time.
Oh, that is so, like, if that song, that version of that song in that big room, place where they're playing, if that doesn't bring you to tears, man, there's something wrong with you, man. It's
Contrast between Eric's voice and his name begins with
Pavarotti, right?
Yeah,
Yeah,
he's got that big,
yeah.
powerful voice, and that was just one of my favorites.
Oh yeah,
Anyways, I think he did that song there too, but
I
that
think
was
so. Some of the his live stuff blends together because I've stopped listening to albums from front beginning to end a lot, but I'm trying to get back into that. And what I've been doing is more just put stuff in a playlist in Spotify, and then so you don't really know, you're hearing a bunch of Clapton, you're not sure like is this from you know the which different venue it was from. But the when you were talking about going with your wife when she was 8 months pregnant to see ACDC, it reminded me of the first time I saw Clapton was when my kids were, I think it must have been probably 7 months um, in their mother's belly. And it was the Staples Center. And he was playing 2 nights in a row, and that turned into a DVD, the One Car, One Rider DVD and CD. And I went to both shows, and we took her so they could experience Clapton like what you did. I did. We
yeah,
were floor seats, but we weren't second row. We were more like 30 or 40 rows back, but I was still happy. And then the second night, I thought, well, that was probably too much for a pregnant person to sit through twice. But
yeah.
that was a great man. You can find that on DVD, on CD, on Spotify. That's a great one. Okay, so
Well,
now go
oh,
ahead.
I was just gonna say one of my favorite covers that Eric did. I'm trying to remember. I don't think he did it at that concert. Was Voodoo Child when he did the long version? Must be
Yeah,
16 minutes long.
yeah.
On an interview, he said that was the hardest song that he's ever had to learn.
Really.
Yeah, I was surprised too. Particularly at their level and their ability to hear all the notes. But for some reason, he just said that was extremely difficult for him.
Huh, I wouldn't have thought that. And it's funny, like if you think back to when he did other Hendrix stuff, like uh, when he went and did Little Wing, and then
Yeah.
he changed it so
Hmm.
much. It's like it's a whole different song, but yet it's the same song.
Yeah.
It was
Anyways,
wow.
I liked his version of Voodoo Child when he did that one.
I'm gonna have to go back and re-listen to that. So I'm going to ask you if you and you can't put that version in there because now we know that you love it. So if you were going to listen to a Voodoo Child, would it be Hendrix, Stevie Ray, or I'm going to put in there Kenny Wayne Shepherd because he always ends his shows with
Too.
that. Which version would you listen to?
Well, I'd have to go with Jimmy since he was the originator of it, but I'd put Eric right up there with him. Particularly that long version because it's just something I could just kind of get into.
Get into? Okay. Yeah, I'm gonna have to
I,
listen to that as soon as this is over.
yeah.
Yeah, that oh man, he Eric is just and he's such a good person. I feel I was so upset that when they were trying to cancel him, and I don't want to turn the show into a political, I'm keeping
I
it
was,
neutral.
I was with you on that one.
Yeah, but that was just man, I stuck
Yeah.
my neck
Well,
out there because he
some of the people that turned against him too. Other
yeah,
musicians were.
I'll just say this, man. I'll never see Robert Cray again because he turned against them. And I've seen Robert Cray. I think Robert Cray is great, but turning against his buddy like that's cold. Okay, enough of that. So we're now on to your favorite studio album, and then there's a fun thing on this. We're going to go through and find out your favorite song on that album. So don't tell us what it is. We're going to do process of elimination. So what is your favorite studio album?
Hear me?
Yeah, now I can
Yeah.
hear you.
Okay. I was
Okay.
just going to say Titanium, John Mayer.
John Mayer Continuum?
Yeah.
Seriously?
You like that one?
That's one of my favorite all-time albums. Are you kidding
That's the
me?
one that comes to my head right now when you put me on the spot.
Oh my gosh, that is one of my absolute favorite.
He's one
Oh,
we haven't talked about much, but yeah, he's another great guitar player that's kind of in the younger generation.
Oh, he is so good. I saw him actually the first time I saw him was at the House of Blues in Chicago, and I didn't know who he was. I was going just to anyways, that's a whole separate story, and it was the John Mayer trio, and it was actually the night that they were recording what turned into uh, his John Mayer Trio live album, and that was, I mean, that was intense and so good. I actually went on two of his cruise. He had two cruises: the Mayercraft one,
Remember that?
Mayercraft two. I think it was in '07 and '08, or '08 and '09, and those were just so much fun. You got to. I've got a picture of him, my daughter, and then he's in the background, and it's
Hmm.
just it's great. Okay, so we are going to try to find your favorite song on one of the best albums of all time, Continuum by John Mayer, out in 2006. And so I'm going to give you two songs, three songs at a time, and you tell me your favorite one out of those. So, and I'm going to take notes here.
Yeah.
So, in order: Waiting on the World to Change, I Don't Trust Myself, or Belief. Out of those three, what's your favorite?
I'd say belief.
Okay. Oh, love that version. And the there's a live version of him playing that just on acoustic backstage.
Okay, I haven't seen
People should YouTube that, and it is just him with the guitar playing it is unbelievable. Okay. Gravity, Heart of Life, Vultures.
Gravity.
Yes. Oh, such a great tune. For a long time, he was ending all of his shows with that one. He kind of stopped. Okay, stop this train. Super heavy song. Slow dancing in a burning room,
Yes.
and
I don't even
bold as love.
slow dancing.
So yes,
That,
so I mean that is
that's a great
that,
verse.
that's a deep
Yeah,
song.
yeah, it's on
Okay.
there. That's one on my playlist that I listen to frequently.
Such a beautiful one. Okay. Oh, these are so heavy. Dreaming with a Broken Heart, In Repair, I'm going to Find Another You.
I'll try in repair.
Okay. In Repair. Now, In Repair, there is a video of him recording that. So he goes, did you see that one?
Hmm.
That's great, right? He goes down to, was it Electric Ladyland Studios that he recorded that at?
That
Or
I don't know. No,
Well, he goes down and he doesn't have a song to record yet, and then he just writes it, and they show him writing the whole thing and creating it, and
wasn't
it's
aware of that. Yeah.
yeah, it's really good. Okay, so now we've got of those your um, belief, gravity, slow dancing in a burning room, or in repair. You cannot go wrong with any of those. Which one is your favorite?
I'd say gravity.
Gravity. Oh, you can't go wrong with that. I mean, Gravity is so heavy. And I think that he wrote that after he came back from a Grammy, and I could be wrong about this. The I think he won some Grammys or something, and then he was just thinking about like his ego, and then I think there was some Stevie Ray Vaughan stuff in there as well that he was going through. Do you remember that
Not that specific. No.
aspect of it? Well,
What's
that is
what's favorite? What would be your favorite on that album?
In Repair.
Okay.
Yeah, In Repair it got me through that album. I listened to pretty much on loop when I was going through some really tough times in life,
Okay.
and that so it's really near and dear to my heart because it really music can really get you through things, and
Hmm.
it was one of the hardest times, if not the hardest time of my life, and I just had that on it. And In Repair was
I get
the
that.
song that really helped me, get through that. I was listening to it yesterday, in fact,
Oh,
because
yeah.
I'm in repair again. But that's a topic for uh, another day. So, wow, this was just so much fun. I've been like when I started doing these Webby Rambles on, I was like, at some point I'm going to bring a guest in, and I'm like, I just hope Bob will say yes to come on because I've just been so excited.
Any-
And you've done so many kind things, and I really appreciate it. Is there anything you would like to leave the audience with, or any other advice, life advice, stock advice, music advice?
Well, on the investment advice, I just particularly young ones just encourage them to whatever approach they use is just have the discipline and really just let compounding work. Because the way I always explained it to my kids, if I gave them like $10,000 at the age of 20 and they're going to retire at say 60, so you have 40 years, and if you double your money 5 years, you got 8 doubling periods. So, 8 goes to 10, 10 goes to 20, and you can do the math. And there's really no reason that people uh, shouldn't at least financially be able to live comfortable in their older ages. But you have to have the discipline to get started. You have to have the discipline to stay and let compounding work for you. Even if you don't do what you and I are now doing for a living,
Hmm.
um, just stay with it and just keep putting some money away and let compounding work for you. And then in terms of trading, I think um, there's so much basically free information that you can get out there to develop a style. But I would also encourage people not to get hooked and just not steal, but take people's ideas. Like somebody mentions a stock and then you just go and buy it. You really should take the time to figure out either why that person's recommending it or putting it on Twitter, or just do your own homework. Because if you're just buying what somebody else says, I just don't think long term that will work, Mike, for you.
Totally agree.
Because you're not going to know when to get out. Is this really going to be a big winner that I should hang in there with? And then the rest of it is just figure out a style. For me, it's growth stocks, and then it's just a matter of finding out what approach you want to use. If you're going to buy patterns or if you're going to buy a moving average. In the beginning, for beginners, I would probably just stick with either a pattern if it's a breakout, or out of a base, because they're probably a little bit safer um, than doing what I do, trying to buy early through a moving average. But there's nothing wrong with that as long as. And then the other thing is just position size. Um, just don't get carried away. And I don't know how should I say this. I think you sometimes just have to take a little bit of a grain of salt with people that produce outside returns. It's not that it can't be done, but that's very unique to be able to do 1,000% in a year. And it doesn't mean it can't be done, but you got to really know what you're doing, be active, maybe use margin. Most people, I don't think, should use margin. Um, I think the more risk you add with the less experience or new, the more risk the more opportunity you're gonna blow up. Let's put it that way.
Yep.
Not that everybody does, but some of the traders. I don't know how long it took Bill, but a lot of people they spent 3 or 4 or 5 years before they get it.
Yeah.
And some have gone through all their money and had to sell stuff. Like, didn't you sell your
Yeah, well, I that was to start off with. I sold my music CDs, and as we know, music is kind of a big deal to me. But
right?
I was out of school, and the work I was playing, where I was working, was not paying me enough to have any extra money. I was kind of going backwards every month, and then I wanted to start trading, and so I sold everything I had. It took me 6 months to raise $540 of selling everything I had, literally going to my piggy bank. Not kidding. It was a rabbit, but it
Right.
was a piggy bank that I'd had from when I was, you know, 10 years old or younger. And it took me 6 months. So I like every penny, like I'm aware of every penny and how hard it is. And then that's how I got started, and luckily I didn't have to sell off stuff, because that was at the beginning of things. But man, I've had bad times, I've had great times, I've had everything in between.
Yeah, I remember 2015, 16. I'm not sure I made any.
So, Bob, you were just saying that we were talking about difficult years, and you were saying I think 2015, 2016 was a challenging year for
I
you.
think it was just more flat, if my memory's right, and so it was just a period where I made very little money. Um,
Yeah,
but on the other, oops. Can you still hear me with
yeah,
one
I can. Yep.
touch? I think that's when I touch it with keep
Yeah, I think
it here.
so.
Should have used headphones, but anyways, you just have to just stay at it because it's going to take a while. Particularly if you're real new, if you're trying to do it for a living, I think it's really hard. Now, when I say this stuff, it doesn't mean that it can't be done. It's this that it's harder. That's all. And so
Hmm.
I wouldn't quit your job unless have the financial wherewithal to do that. And I still wouldn't do it then, anyways, if you have no experience. Um, and then just start small. But the key is just to get at it. The real key is just to start saving and putting money away. Um, I've always been an equity guy. I've never owned a bond, Mike.
Me either.
Never owned a bond. I've been stocks. My net worth is our two homes and my account. I don't own any. I don't own anything else. Um, no,
And
come on.
that's pretty much how Bill was too. He would do real estate in terms of, you know, his house or some other properties, or he'd buy the properties of the company, and those were substantial.
Right,
And and he wouldn't go on debt. He would never go on debt. I think he said the most debt that he ever went on was like 4% or something. It was probably just cash flow issue.
right.
But he just, because he'd made it, all by 1962, 63 time frame, and he'd made enough to start the firm,
Hmm.
and then just he never blew up, which is just so rare for someone who would trade so different than you, like your 5% positions, versus his 200% long one stock. And just fascinating to, and I think hearing both of those, knowing that's how Bill did it and this is how you did it, that there's so that you could just find what works for you. Everyone can find what works for them. And where I always say, you know, I struggled so much trying to be Bill. Like I kept on trying to be Bill, and I'm not. And it finally realized I'm not Bill. I just need to be the best Mike I can be. And then that changed a lot of pressure too, because there's not going to be another Bob, there's not going to be another Bill, there's not going to be another Joe Schmo or anyone else. It's like everyone is unique, and it's so the, there's so much emotion involved and psychology involved with trading. The technical stuff is kind of easy to get down. It takes a couple years and get that down, and you can always get better. I'm always trying to get better. I'm sure you are, but really it's about psychology. And I think folks listening to you and the way you set it up to succeed, like if you try to go 200% long a stock, you're setting yourself up for failure. You go the way you're doing it, start off with 1%, max it out at 5%, and not average down. You're going to be in the game for 30, 40, 50, 60 years. It's unbelievable. I'm so impressed. I'm even more impressed now after hearing you than before.
Can you hear me? I would just encourage everybody to stay with it and learn and try to develop whatever works for them, and just take your time and just stay with it. If you just have to use a kind of a dollar cost, kind of what I do with my kids, because they're in the financial business, so we have to get pre clearance on any trades I want to make in individual stocks. So we kind of just use ETFs, and we just trade off the 50-day. So above the 50-day, we're long, and then below the 50-day, we start scaling back. We don't scale back 100%, but I'll probably cut 50%, 3 or 4% around the 50-day, and then I'll use the 200-day. So you can keep something simple like that, and just pick your favorite ETF or a bunch of ETFs. But
Perfect. Well, thank you so much, Bob. It was a true honor, and I'm sorry about the technical issues that we had, but you are just, I'm just so grateful that you spent 3 hours with us, and I think so many people are going to get so much out of this, and just thank you for everything.
you're welcome. Yeah, can you still hear me?
There we go.
Okay.
Yep.
Yeah, feel free if any of your folks want to ask me questions, Mike. They can either just reach out to me on Twitter. I don't mind helping that
Oh,
because I really don't post a whole lot other than my stuff that I put up there, spiritual stuff or health stuff.
yeah, I
Uh,
love your
but
spiritual.
if anybody has any technical questions, they can just ask me, and I usually answer everything that I questions I get. So
Great. Well, we'll put up your handle, but just if you could just tell everyone your Twitter handle or your X handle so they can hear it.
that's RFEHRM. This
Perfect.
our firm.
Perfect. Well, thank you again, and I will let you go have fun with the grandkids.
All right, thanks, Mike. It was enjoyable for me too.
Thank you.